Hello my dear CMA Final students. A lot of you have been asking revisions of important topics of CMA Final Corporate Financial Reporting, and hence I thought I will release a series of videos which will help you revise some important chapters from examination point of view. And in this line today we will discuss about financial instruments. So we will talk about theory, we will also discuss questions from your material, from past exams and from the workbook, so that after watching this about 2 hours of video, that is my target, you will be 100% confident to attempt the question in the examination. And we know every attempt we get 7 marks, and sometimes MCQs are also tested, and hence this topic becomes very important. Now without wasting much of the time, let us start with financial instruments. What is the meaning? How do we account for it? Classification, liability, compound financial instruments and everything. Now before I jump into the topic, I want you to visualize a balance sheet in a T-shaped format where we have assets, where we have liabilities and we have equity. Whatever you realize from asset, you will pay off the liabilities and the remaining component is called equity. Now for assets like inventory, property, plant and equipment, we have separate specific standards. For liabilities, we have a general standard Ind AS 37. We also have standards on employee benefits, right? We also have leases that talks about both assets and liabilities. So we have standards for almost most of the items in the balance sheet. What was earlier missing was handling assets like cash, trade receivables, loans given. On the liability side, loan taken, a specific guidance on how to handle equity. All of these were not specifically covered under accounting standards, the earlier accounting standards, right? And for them, we have this specific standard that is called financial instruments, which talks about how to handle some kind of assets, liabilities and equity, covered by 3 standards: Ind AS 32, Ind AS 107 and Ind AS 109. 32 largely talks about the definition part. 107 largely talks about the disclosure part, it's only a disclosure thing. And 109 talks about the core accounting aspect, which is the most important part amongst these 3. We read these 3 standards together, alright. So our focus will be on 109 and some aspects of Ind AS 32. Now what is a financial instrument? Financial instrument is either a financial asset for one entity, and on one entity it's a financial asset, for another party it becomes either a financial liability or equity. Which means when we talk about financial instruments, on one side there will be financial asset, on other side you will have financial liability and equity, alright. Now when we say financial instrument, the most important thing that we need to keep in mind is a contract. There has to be a contract for most of the financial assets that we are talking about. Okay. In fact, we will see a term called cash. Cash also is a promise by the government, right? So it is in a form of a contract itself, but we don't call it a contract in general terms. So when you have a contract which gives financial asset to one party and financial liability and equity to another party. Let us understand with an example. You sold goods, or a company sold goods on credit. When we sell goods on credit, how do we present it in the balance sheet? We will say, sir, there is a trade receivable. Okay. Now when we buy or sell goods, there is a contract. It can be an implied contract also. So there is a contract under which a trade receivable is created. This is a financial asset for one party. Correspondingly, the purchaser, what will they say? Sir, we have trade payable. So on the other side you have a trade payable, on this side you have trade receivable, hence these are financial instrument. Similarly, if you have something like, let us say, investment in shares. I have invested in shares of Reliance. This becomes my financial asset, and correspondingly for Reliance under equity, it becomes a equity component. So financial asset on one side, financial liability or equity on another side. This is the crux. Now, whenever we talk about financial assets, what do we have? We have items like cash or deposit with bank. So all cash and cash equivalents are our financial asset. Then any right to receive cash Any right to receive cash under a contract. There has to be a contractual right to receive cash. Like I said, when I sell goods on credit, there is a contract between the seller and the buyer, and I have a right to receive cash. Hence, it is a financial asset. There has to be a contractual right to receive cash or any other financial asset. So, it can be a contractual right to receive cash or any other financial asset. Maybe I have a right to receive equity instrument, which is another financial asset. Even that contract becomes a financial asset. So, what do we cover in financial asset? Number 1, cash. Number 2, contractual right to receive cash or another financial asset. So, when I say contract, it can be a loan transaction, it can be a sale purchase transaction, but where there is no contract, I cannot call it a financial asset. For example, I have income tax refund receivable, right? Whatever TDS has been deducted, it has to be refunded to me as income tax refund. I have a right to receive cash, yes, 100% agreed, but this right to receive cash is not under a contract, it is under a law. That is not a financial asset. I hope it is clear. So, you need to have a right to receive cash. Then, third component is any equity instrument of another entity. Now, equity, we will again understand it separately. So, if I have invested, a simple example, in equity shares of Infosys, it is a financial asset. Then, if there are exchanges of financial assets and financial liability in favorable situation or in favorable terms. Now, this we need to understand with example. We will understand both for asset as well as financial liability side. Okay. Now, what is the meaning of exchange financial asset and financial liability? For this, I will introduce you to a concept called derivatives. Definition part will come to it later. Derivatives includes what we say futures, forwards and options. Alright, it has futures, forwards and options. I will explain this with an option example. Remaining two aspects will cover slightly later. Okay, right now you don't need to understand it to understand the accounting part of it. Now, what is an option? Option is something that gives the holder a right to buy and underlying. Right to buy and underlying means what? It can be a simple thing like right to buy shares. So, say for example, we are talking about Reliance Industries Limited, okay, and I have an option to buy. Option to buy is called call option. Sir, why call option? I am calling that instrument. Instrument will come to me. So, when will an instrument come to me? If I buy. So, I have an option to buy, which we call a call option of Reliance at, let us say, 1500 per share. Now, one thing you need to understand is whenever there is an option, option is a choice, it is not mandatory. If I want, I will buy, if I don't want, I will not buy. So, I agreed to buy at 1500 per share, I paid some upfront premium and all. Subsequently, let us say the price increased to 1700. I have agreed to buy or I have an option to buy at 1500, price increased to 1700. Now, I can still buy at 1500 under the contract. Is it beneficial to me or not? Yes, of course, it is beneficial to me. So, here what will happen subsequently? I will exchange cash and or with Reliance Industries Limited shares. I will give cash 1500, I will take Reliance Industries shares from you which is worth 1700. So, is it favorable or not? Yes, of course, it is favorable. So, if there are exchanges of this type which are favorable, then we say there is a financial asset. Now, look at the other party. Other party had agreed that they will sell Reliance Industries shares at 1500. Today the market price is 1700. If I have to sell something of 1700 at 1500, is it favorable or unfavorable? Of course, it is unfavorable. So, in such a situation, that becomes a financial liability. Okay. So, what happens is under this definition, there are two things. One, you exchange financial asset and financial liability in favorable terms. That is called in the money options. That is when there is benefit right? So here if it is favorable, it is a financial asset. If you exchange financial asset and financial liability in unfavorable terms, this happens in case of sold options. So I had purchased a call option, you had sold a call option. So the purchaser of the call option, because the price increased, has a favorable scenario, and you, because you have sold the option, you have unfavorable scenario. So if you exchange financial assets and financial liability in unfavorable terms, this is a financial liability. So quickly, what all did we say? Financial asset, cash. Second, contractual right to receive cash or another financial asset. Third, equity instrument of another entity. Fourth, exchange financial asset or financial liability in potentially favorable terms, and if it is unfavorable terms, it is a financial liability. Now, like we have a right to receive cash, if there is an obligation to deliver cash, it becomes a financial liability. So, financial asset of one entity, financial liability of another entity. Then, equity instrument of another entity will be classified under equity. Alright. So far we have covered 4 scenarios of financial asset and 2 scenarios of financial liability. Then the last one, whenever there is settlement in own equity. Now this again can be equity, financial liability, financial asset. 3 things are possible. Now sir, what is the meaning of settlement in own equity? For that we need to understand what is an equity. Equity is a residual interest of the entity. So I gave you this example, right? You have assets, you have liabilities. After you settle the liabilities, whatever is left is called equity. Okay, this is the residual interest. So equity shares issued, those are equity interest. Alright. Now, if the entity is under a contract and they have to settle the contract in their own equity shares, then it can be either a financial asset, it can either be a financial liability, it can either be an equity. Sir, what is the meaning of that? Let us understand all the 3 scenarios. Number 1. Let us say the entity agrees to issue 1000 shares at rupees 100 each. If you remember, we have something called as share based payment. So the entity has said to the employees, I will give you 1000 shares at what? 100 rupees each. Now here tell me, are the number of shares fixed? Yes sir, 1000 shares are fixed. Is the issue price per share fixed? Yes sir, 100 rupees, that is also fixed. So if there is a fixed to fixed exchange, then we say this is in the nature of equity, because I know how much will I get from the contributor, I know how many shares I have to issue. Subsequently the price of the share may go down, go up, it does not matter to me, the owner will bear the risk. Ultimately, who is the equity? Equity bears the risk. Now here, when the price is decided, number is decided, subsequent fluctuation in share prices, who will bear the risk? The owner will bear the risk. Hence, such transactions, when there is a fixed to fixed exchange, we call it fixed to fixed. Number is also fixed, consideration is also fixed, then it becomes an equity. If it is not fixed, of course, the definition has terms like derivative, non-derivative and all of that, but for your examination purpose, for your remembering purpose, if it is not a fixed to fixed contract. Sir, what is the meaning of not a fixed to fixed contract? Let us say the entity agrees to issue 1 lakh worth of shares. The entity agrees to issue 1 lakh worth of shares. Now tell me, is the number of shares fixed here? No, because subsequently if the price changes to 100, 150, 200, 50, whatever is the rate, depending on the share price, depending on the value of shares, the number of shares will change. So if it is not a fixed to fixed contract, then it can become a financial liability or financial asset. When will it become a financial liability? When the entity has to issue. So if the entity has to issue, it becomes a financial liability. If the entity has to receive, it becomes financial asset. Sir, why will the entity receive its own shares? There is something called as buyback. The entity may buy back from the existing shareholders, right? So in such scenario, it will become either a financial liability or financial asset. One more thing. If the entity agrees to buy shares from the shareholders where the number of shares are fixed and the amount is fixed, means number of shares as well as the value per share or the total value is fixed, then it will become an equity transaction. So, buyback of shares where both number and price is fixed, that becomes a equity. But if the number of shares are not fixed, then if the company has to issue, it is a financial liability. If the company has to receive, it becomes a financial asset. Mostly we see financial liability situations only. Alright. So, what is the last one? Last one is when the entity has to settle in own equity where they give variable number of equity, or if there is if it is not a fixed to fixed contract. In these two scenarios, it becomes a financial asset. If the entity has to issue, it becomes a financial liability. Here it is received, here it is delivered. And if it is fixed to fixed, that means if it is not variable, then in that case it becomes an equity transaction. Okay. In summary, whenever we have this exchanging financial asset and financial liability, when there is a gain, we call it a derivative asset. When there is a loss, we call it a derivative liability. Preference shares we will discuss later. Okay. I hope the conceptual part is clear for introduction of financial instruments. Then there is something called a puttable financial instrument. Now, as I told you, when we say call, I am calling the instrument. When I am saying put, so for example, if I have to say put, calculate, if I am putting it forward, it is for selling purpose. That is what you have to remember. Okay. So, if it is a puttable financial instrument, puttable means what? You are giving back. Who will give back? Holder will give back. Now, let us say I have issued you some instrument and if you are putting it back to the entity, I am the entity, I have given you some instrument and you are putting it back to me. Okay. Now, whenever there are puttable financial instrument, what we need to understand is these are generally in the nature of liability. For example, if there are redeemable preference shares, a preference shares has to be redeemed after 10 years. After 10 years, the preference shareholders, I have an obligation to pay cash. Whenever there is an obligation to pay cash, then it becomes a liability. Am I clear? If there are preference shares which are redeemable, it becomes a liability. Now, what is this puttable financial instrument? It gives the holder the right to put the instrument back to the issuer. The holder has a right to put it back or is automatically put back to the issuer due to the occurrence of an uncertain event. So, things could be like, for example, let us say if there is a joint venture. Joint venture is for, let us say, a construction of road. Now, we have invested in this joint venture. Okay, we have invested in this joint venture. After the construction of the road is completed, the joint venture will redeem the investments. Okay, which means what? It is automatically the instruments is put back. So, if you have invested in this joint venture, you would have received, let us say, shares. Those shares will be redeemed once the construction is completed. Okay. Now, one thing you need to understand is whenever the other party, the holder has a right to put back the instrument, it becomes a liability. The reason why it is a liability is, if you see equity, does equity have a right to give the equity shares back to the company? They don't have right. If the company wants, company can buy back. But the equity shareholders do not have a right to put back the instrument to the shareholders. So, whenever we see puttable financial instrument, these are generally a liability. But then there are certain exceptions. One exception is, let us say, our mutual fund. Now, if you invest in a mutual fund, what do you get? You get units, correct? These units are these units can be redeemed if it is an open-ended fund anytime, and these units will make you owners. If you have invested in a mutual fund and you have invested some amount, you got the units. These units give you what? Net assets of the company. You have a right on the net assets of the mutual fund, correct or not? Now, though you have a right to net assets and you are owner, you have a right to put it back whenever you want. For an open-ended fund, you can say, give me my money back. Means what? Whenever you want, you can give the units back to the company. it is a puttable financial instrument, and generally these are classified as liability. However, are these not the owners? In substance, the unit holders are the owners. So what the standard says is, in certain situation, you will classify it as equity if it represents an ownership interest in substance. For example, for this there are some conditions. Number one, holder is entitled to pro rata share of net assets, like in the case of equity. It is subordinate to all classes of instrument. It will be last. If the entity goes under liquidation, these holders will get the payment at the last, and there are no other contractual obligation to deliver cash or financial asset. There are more conditions, but for you these many conditions are sufficient. If these conditions are satisfied, you will classify that as equity. Now think of that unit of the mutual fund. Is the holder entitled to pro rata share of net asset? Yes, we will get what? We will get NAV per unit. If today if the mutual fund closes down, these unit holders will be paid the last. So they are subordinate. They are subordinate to all classes of instrument, and there is no other contractual obligation apart from repayment of the net assets. There are no other contractual obligation, and hence these puttable financial instruments in some situation are classified as equity. Okay. Generally they are classified as liability. This is the base introduction of financial instrument that you need to understand. Now we will move to the important aspects with relation to accounting, where we understand how do we classify financial asset, that is one thing, and how do we do the accounting under each category. Alright. Now when we say classification of financial assets, what are these? Cash, trade receivables, loan given. Loan given is a financial asset. Why? Because I have a contractual right to receive cash. Now if I give loan, what are the two cash flows I get? I get principal and I get interest. So there is a contractual right to receive both principal as well as interest. That is a loan, which is a financial asset. Am I clear? Very good. Now whenever there are financial asset, and this classification is large, and this classification is largely understood with reference to investments in debentures or investment in bonds or loans given. Okay. There are three categories. One is called the amortized cost method, second one is called fair value through other comprehensive income, and third one is called fair value through P&L. Three categories. Now how to classify in these three categories? For that we have to check what is the contractual cash flow, what is the business model. Sir, what is the meaning of contractual cash flow? See, financial asset is a contract. Under the contract, what are the cash flows? Under the contract, what are the cash flows? If I give loan to you and we enter into a contract, what are the cash flows? You have to repay the loan, you have to pay me the interest. Yes or no? Yes. If I invest in debenture of a company, again periodic interest payment and principal repayment at the end. If I invest in equity shares of a company, what are the contractual cash flows? There are no contractual cash flows. If I invest in the shares of Reliance, do I have any contractual right to receive cash? No. Only when the company wants, they will give me dividend, and when the company winds up, they will repay the money back to me, or if the company wants, they will buy back, but I don't have any right. I don't have any right. So you have to first check what is the contractual cash flow and whether the contractual cash flow is only of principal and interest. It has to be solely the payment of principal and interest. It has to be solely the payment of principal and interest. That is the first thing. Okay. If the contractual cash flow is solely the payment of principal and interest, best example is, let us say I have invested in bonds or debentures. Under this I am entitled to get interest periodically and I will get principal. Okay. See, it may be possible the company does not pay interest periodically, but other than these two there must not be any other payment. Okay. Other than these two there must not be any other payment to use the first method, right. So it has to be payment of principal and interest. See, interest can be paid at the end also, but it represents payment of principal and interest. Then second thing you have to ask is, what is the business model? Now if I buy bonds of a particular company today, what are the two choices? I can hold the bond till maturity, or if the interest rate changes, I can sell the bonds in the market. Both the scenarios are possible. Number one, I can see that okay, these are the bonds I want to hold till maturity. Second option is I will sell whenever I want. So what is the business model? To hold till maturity or sell? Alright. Now, if it is an instrument, a financial asset whose payment is only of principal and interest, other than these two there are no other payments, and if the business model is to hold till maturity, payment principal and interest, hold till maturity, we apply amortized cost method. We get principal, interest, intention is hold to maturity. Now one thing, this does not mean that the entity cannot sell it. If the entity wants, they can sell it also. But intention, the business model, the way the business functions is that I have invested in the bonds and I will hold it till maturity. Then we follow which method? Amortized cost method. This can be applied only for debt cases or only when there is debt or loan. I cannot apply it in equity. Why? Because in equity there are no contractual cash flows of principal and interest. Alright. I cannot apply it for any derivative asset because again there are no contractual cash flows. So it can be applied only in case of debt. Right. How to do the accounting? I will come to it. First understand the classification. Amortized cost method, it will be principal and interest only and we will hold it till maturity. Sir, the company wants principal and interest, but the company can sell whenever it wants to. In that case, we use fair value through other comprehensive income. So here also contractual cash flow is payment of principal and interest, but categorization is fair value through other comprehensive income because we may sell whenever we want to. So there is principal, there is interest and there is this selling component. Under both this method, we follow something called as effective interest rate method for calculating interest. This we will understand with an example. In both the cases, calculation will be on the basis of same method or same effective interest rate. Means amortized cost method and fair value through other comprehensive income, interest rate calculation will be same. Alright, then. If anything does not fall in amortized cost method or fair value through other comprehensive income, we will use fair value through P&L method. Now, one thing you need to understand is for fair value through P&L, when we do the accounting, something which is held for trading that always goes through fair value through P&L, derivatives goes through fair value through P&L. If the entity wants for other kind of instruments, that also can go through fair value through P&L, right. So, derivative trading, and if we are told to avoid accounting mismatch, we will use fair value through P&L. Three methods. First one, amortized cost method. Amortized cost method is when my intention is to get principal and interest and hold it till maturity. Second category, fair value through other comprehensive income, principal, interest, and I want to sell it. Third category, the residual category. Now sir, why is the accounting different? See, when I am talking about amortized cost method, what is my intention? I want to earn interest. Other than that, there is no other intention to earn any other income. So if I only want to earn interest, I should do only interest related accounting, and that is where the standard suggests something called as effective interest method or effective interest rate to account for amortized cost method. Okay. When it comes to fair value through other comprehensive income, my intention is to sell. So what the standard says is, whenever there are changes to fair value, that fair value gain or loss, whatever you get, you should recognize it in other comprehensive income. Alright. Now, I have not sold or I will not sell this instrument today, but the fair value changes will impact my gain or loss, because if fair value increases and if I sell, I will make a gain. If fair value decreases, then if I sell, I will make a loss. So this gain or loss of fair value changes should be recognized. Okay. This is about debt. Then remaining all other categories of financial assets are generally put under FVTPL category. There are some exceptions, but generally FVTPL category. One very important exception is equity. If you have equity investments which you would typically recognize in FVTPL, the standard allows you to record it under FVTOCI, that is fair value through other comprehensive income. Normally equity instruments, you will take it as fair value through P&L, but the standard allows you to record this equity instrument under fair value through other comprehensive category. Now this decision is irrevocable. If you have decided that investment in equity will be under FVTOCI, you have to continue to recognize it under FVTOCI only. That is fair value through other comprehensive income only. Okay. Then once you have classified, you cannot bring back. And second thing is, whatever is the fair value gain or loss, you cannot reclassify that to the P&L. So I will just note down for you once again so that you do not forget. One is amortized cost method, second one is fair value through other comprehensive income method, third one is fair value through P&L method. Under amortized cost method, you get only principal and interest and you hold till maturity. Here also you get principal plus interest, but you can sell, means the intention is there to sell. This is the residual category. If something is for trading or if something is a derivative, it will always come under FVTPL. So can I have equity under ACM? No. Equity will be under FVTPL. But there is an exception. What is the exception? If the entity wants, instead of FVTPL, they can have FVTOCI under equity. So equity can be put under FVTOCI. Now if I put equity under FVTOCI, two things happen. One, this is irrevocable, you cannot change. And second is that any fair value gain or loss cannot be transferred to P&L. See, if you do under FVTPL, any fair value changes, gain or loss will be recognized in P&L. But if you do FVTOCI, fair value gain or loss will be recognized in OCI, and even when you sell the equity instrument, the fair value changes cannot be recognized in the P&L. Only the gain or loss on disposal will be recognized in P&L. Okay. These are the three categories. Alright. Now, how do we account for each of these categories? Typically, any financial asset or any financial liability for that matter is initially recognized at fair value. Okay. Of course, transaction cost discussion is there, but initially recognized at fair value. Normally, transaction price is assumed to be fair value. Sir, what if transaction price is not the fair value? There is a separate discussion. But normally, whatever is the transaction price is assumed to be the fair value. If transaction price is not available, then present value of cash flow discounted at market rate is equal to the fair value. So, if transaction price is given, we will take the transaction price. If transaction price is not available, we will take present value of cash flow discounted at market rate, that will be the fair value. Okay. Now, this part I will take an example and explain it in further detail. Now, when we talk about initial recognition, in case of initial recognition, we will take fair value plus transaction cost. Fair value plus transaction cost. Sometimes if it is a reversal of transaction cost, means if the other party is paying back the transaction cost, we may have to reduce also. So it is fair value adjusted for transaction cost. Alright. Subsequent accounting is done using effective interest method. This too we will take an example and we will solve it. When it comes to FVTOCI, initial recognition is again fair value adjusted for transaction cost. Fair value changes is recognized in OCI, interest is accounted using effective interest method. Okay. Then, in case of FVTPL, here is what you have to keep in mind. The initial recognition is at fair value only, whereas transaction cost is directly recognized in P&L. And any fair value changes are also recognized in P&L, interest or dividend is also recognized in P&L. Right. So, this is the summary of accounting of all of these three methods. Now what we will do is, we will take up one question and see how it is accounted for under amortized cost method, under FVTOCI method, and what will happen if it is FVTPL method. Let us now have a look at a question where we understand the accounting under all the three models. On 1st April of 21, ABC purchased 1 lakh 6% bond for 95,000, incurring 3,000 as transaction cost. So what has happened? 1 lakh 6% bond. Now what is the meaning of this 1 lakh? This 1 lakh is the face value, what we call, or also the par value. Any interest payment, that is the cash payment of interest. When I say cash, cash or bank, The payment of interest will happen using the face value. So then what is the 6% bond? 6% bond means the coupon that the bond carries. So this is face value. This 6% we call it to be coupon or interest rate. Now on this bond what will happen is 1 lakh into 6%, that is 6,000. Every year annually the company will pay 6,000 as interest. The interest cost may be different, but payment will be 6,000. Purchased for 95,000, this is called the transaction price. What they have purchased it at? 95,000. Now tell me, if I am getting 6,000, okay, forget the transaction cost for now, just for an understanding. If I am getting 6,000 as interest, by investing 95,000, will my interest return, that is return of income, or my income, interest income, will that be 6% or more than 6%? For example, if I take only 1 year, okay, I take only 1 year period and I say I will buy something at 95,000, okay, on this I am getting 6,000 interest. If I had invested 1 lakh, then I know it is 6%. But if I have invested 95,000, definitely I am earning more than 6%. Agree or not? How much am I earning? That will compute. But on 95,000, if I am making 6,000, I am definitely earning higher, right? This higher rate of interest, when we calculate, we call it effective interest rate. This also can be referred to as IRR of the bond, or sometimes yield to maturity of the bond. Multiple rates can be given. Okay. And they incurred 3,000 as transaction cost. Okay. So how much is my investment? 95,000 I paid to buy the bond. Apart from that, I paid 3,000 as transaction cost. Maybe some brokerage, some registration duty, stamp duty, fees, something. I incurred 3,000. So now what is my total investment? 95 plus 3, 98,000. Okay. The bond pays interest annually in arrears. Arrear means at the end of each year, and will be redeemed at a premium of 3,973 over its nominal value on 31st of March of 24. So what has happened is, if I draw a timeline and explain it to you, we are standing here, we call it 0, year 1, year 2, year 3. On this date, this will be matured. Okay. How much did I invest today? 95,000 is I paid and 3,000 I incurred as transaction cost. Totally 98,000 is my outflow on day 0. Okay. In year 1, what will I get? I will get interest of how much? I will get interest of 6,000. Year 2, I will get 6,000. Year 3 also I will get 6,000. And at the end of year 3, the company has to pay back the loan or redeem the bond. Bond, unless otherwise mentioned, will be redeemed at the stated value or the face value. Now here what they have said, it will be redeemed at 3,973 premium over its nominal value. So what we will get? 1 lakh 3,973. 3,973. So in the third year, how much will I get? 1,09,973. Okay. So see, I invested 98,000. Every year I got 6,000, 6,000, 6,000, and also at the end I got 1,03,973. So 98,000, instead of 98,000 what I have invested, how much did I get? 103,973. Is this also not my income? This is also my income. So when we account for these financial asset, not only this 6,000 of income, this extra amount that you have received, not only 3,973, 98,000 minus 103,973, everything put together we say is our interest income. So then how to calculate? We calculate using IRR or effective interest rate. Basically, we have to compute a rate at which, when I discount all of these, okay, all of these inflows, I will get 98,000. Okay, that is what is called effective interest rate. Now this will be given to you in the question. If it is not given, you have to use the IRR formula and calculate. Okay, so here what have they said? Let us read. The effective interest rate is 8%. Now I will give you a very small working for your understanding purpose only. You don't need to do that in the examination. Okay, this is year 1, this is year 2, this is year 3. Discount rate is given to be 8%. Now 8% is such a rate at which present value of all of these payments will become equal to 98,000. That is what is called the effective interest rate. In other words, IRR. the rate at which when I discount all the cash flows, the present value should be equal to my outflow on day 0. That is the effective interest rate. Alright. So, if I take 8% discounting factor, if you have this calculator, what you can do? You can do 1 divided by 1.08 is equal to, you get 0.9259 is equal to 0.8573 is equal to 0.7938. Okay. So, what is the present value? 6000 into 0.9259 is equal to 555.4. Then 6000 into 0.8573 is equal to 5143.8. Then 109973 into 0.7938 is equal to 87296.5. Grand total, I get total of all of this 97995.7, which is approximately equal to 98,000. So, what happened? At the effective rate of interest, the present value of all the cash flows is equal to 98,000. Now, think of it from the investor's point of view. Can the investor say that? Can the investor say that I invested 98,000 today and I earned 8% return over a period of 3 years? That is what is happening here. We invested 98,000 today. Whatever is the cash flow, we got 6,000 and at the end we got 3,973 extra. Can we say that yes, the investor has earned 8% rate of interest? That 8% is basically the effective rate, and which is generally the market rate of return. Okay. Now, one small note for you. Generally, the effective interest rate is market rate of return, but if there are transaction costs involved, then the effective interest rate will be higher than the market rate of return. Whatever it is, the question will give you what is the effective rate of return. Okay. So, here the investor has earned 8% per annum. The investor has earned 8% per annum. Now, when we do the accounting, how do we do? If it is amortized cost method, we will have one form of accounting. FVTOCI will have another form of accounting. FVTPL we have another form of accounting. The fair value of the bond at the end of each year is as below 1,10,000 first year, 1,04,000 second year. How the bond would be accounted for in the following scenarios? Give the calculation along with its presentation in the financial statement. The working that I did to calculate the present value is not required in the exam. When you have the transaction price and when you have the transaction cost, initial recognition will be at 98,000. For fair value through other comprehensive income and amortized cost method, initial recognition will be at transaction price plus transaction cost. Okay. ABC's business model is to hold the bond until its mature. So, if the intention is to hold the bond till its maturity, we follow which method? Amortized cost method. In case of amortized cost method, initial recognition will be at transaction price plus transaction cost. So, initial recognition will happen at 98,000. Subsequently, for amortized cost method, we prepare something called as amortization table at 8%. How does it work? You will plot year, opening balance, interest at 8%. This is your income. Then payment at 6%. This is your receipt, and you will have closing balance. Now, year 1, first year, what is the opening balance? 98,000. What is the interest? 98,000 into 8%, 7840. What is the receipt? 6,000. What is the closing balance? Plus is equal to minus 6,000. Closing balance is 99840. Okay. Second year, 99840 into 8%, 7987 plus is equal to minus 6,000. You get 101827. Third year, 101827 into 8%, 8146. 6000 is the payment plus is equal to minus 6000. If I do, I get 103973. 103973. 103973. This also will be paid along with it plus 103973. This balance will become 0. Sometimes if this balance does not match the redemption amount, the interest has to be the balanced figure, which we will see in some of the questions. So, when we are following amortized cost method, first thing, what is the initial recognition? Transaction price plus transaction cost. No need to do a present value of future cash flows if the transaction price and transaction cost are given. So, initially how will you recognize? You will say investment in bonds, account debit 98,000 to bank 98,000. At the end of year 1, what happened? We got interest income, we got 6,000, bank account debit 6,000 to interest income. Interest income is how much? 7840. So, what happens to the balance? Balance amount gets added to the bond value. So, you will add that to investment in bonds. See, we had to receive 7840, we received only 6,000. So, 1,840 got added here. So, you see 99840, 98,000, 99840, 1,840 got added, right. Like this you can pass entries for second year and third year. So, we prepared this table: opening balance, interest, payment, closing balance. The closing balance at the end will become 0. Interest income 7840, 7987, 8146, that is how it will be accounted. Balance sheet value will be this closing amount. Okay. Second they said if it is using fair value through other comprehensive income. Now, what is the second model? ABC's business model is hold the bond until maturity, but with the flexibility to sell if it has more attractive investment opportunities which arise. So, whenever the intention includes an option to sell, we want to sell, if we can sell, we follow FVOCI method or FVTOCI method. Now, as far as FVTOCI method is concerned, it is just an extension of this method. Here you will note what is the fair value. Now, fair value at the end of each year they have given 1,10,000 and 1,04,000, 1,10,000 and 1,04,000. Here of course it is redeemed, no problem, right. Then what happens is we have to see what is the fair value gain or loss. Carrying amount is how much? 99,840. In the market the fair value they are saying 1,10,000. So, 99,840 minus 1,10,000 if I do, that is how much? 10,160 of gain. Okay. So, this gain has to be recognized. This gain has to be recognized. Now, see, my carrying amount was how much? 99,840. I have recognized gain of how much? 10,160. Now, what is my revised carrying amount? My revised carrying amount is nothing but 99,840 plus 10,160, which is nothing but 1,10,000. I will show the bond at 1,10,000. So, then what about this gain? This gain has increased the value of my bond. So, I will say investment in bonds 10,160 to other comprehensive income 10,160. Now, come to the second year. What is the carrying amount at the second year? Do not say 10,187. Do not say 10,187 because now the carrying amount will be based on 1,10,000. Carrying amount will be based on how much? 1,10,000. 1,10,000 plus interest minus receipt 1,10,000 plus interest 7,987 minus 6,000. Revised carrying amount is 1,11,987. Fair value is how much? 1,04,000. Fair value is how much? 1,04,000. So, minus 1,04,000 if I do, I get a loss of 7,987. So, in the second year what you will do? You will say OCI debit 7,987 to investment in bonds 7,987. So, it will be carried at what value now? 1,04,000. 4,000. At the end of the third year, the closing balance and the fair value will be the same. Now here it is 0, so it will be just disposed of. Now in the second scenario, when the model is to hold to collect and sell, we follow FVOCI. Here what is the change that I said? Though I calculated in the same table, what you need to understand is interest will be calculated like we have done in the previous thing. Okay. So opening balance 9,800, interest 7,840, receipt 6,000, closing balance 9,9,840, fair value is 1,10,000, 10,160 goes to OCI gain. Second year, opening balance will start from this, interest will be calculated as per effective interest rate, payment will also come as per 6,000, closing total amount will become 1,11,987, whereas closing balance fair value is 1,04,000. So we will recognize the loss of 7,987 in OCI. In third year, what happens? You start with 1,04,000, interest is 8,146, amount that you will receive is 6,000 plus principal. So net you are left with 2,173. But now the bond has been redeemed, the value will become 0. So this 2,173 will be reversed out from OCI to P&L. So actually if you see 10160 minus 7187, 10160 minus 7987, if we do, we get 2173. So this 2173 balance will be now recorded in OCI as a loss. Alright. The balance has to be written off because 1,04,000 plus 8,146 minus the receipt gives us a closing balance of 2,173. There is no closing balance. So what we will do? We will reverse that amount from OCI. Alright. Third category. ABC's business model is to trade bonds in the short term. Assume that ABC sold the bond at its fair value on 1st of April of 22 and the fair value is 1,10,000. Okay. So if the model is to trade, then what happens? You will record the bond at fair value only. Transaction cost is recognized in P&L first. Second, interest you will directly take whatever you receive 6,000 as interest income and balance you will do the fair value gain or loss. Okay. So bond is recognized at 95,000, 3,000 of transaction cost are expensed, interest income 6,000 recognized in P&L, fair value is how much? 1,10,000, cost is how much? 95,000, 15,000 is recognized in P&L. Okay. Then on 1st of April when the bond is sold at 1,10,000, you will de-recognize the financial asset. No gain or loss is recognized because carrying amount is also 1,10,000 and sale value is also 1,10,000. Okay. A simple way to understand the accounting of bonds or financial instruments using amortized cost method, fair value to other comprehensive income and FVTPL. In examination question, most of the time you will get amortized cost method only. And the same method we will apply when we do a split of compound financial instruments as well. Now so far we have understood the three categories in which we account for financial asset. Amortized cost method, fair value through other comprehensive income, fair value through P&L. Initial recognition in case of amortized cost method and fair value through other comprehensive income will be transaction price adjusted for transaction cost. If transaction price is not available, we will compute present value of future cash flows at market rate of return or effective rate of return given in the question. Alright, okay. Then when it comes to fair value through P&L, initial recognition will be at fair value only, transaction cost will be recognized in P&L. So say for example, if a company invests in equity shares of another company, then any transaction cost like brokerage etc. will be charged off to P&L if FVTPL method is being followed. For amortized cost method, every year you will calculate interest using the effective interest rate and we will prepare a table where we say what is the opening balance, what is the interest, what are the payments and what is the closing balance. In case of FVTOCI, we will do the same calculation but the closing balance has to be fair value and any difference will be taken to OCI. Alright. Now whenever we have this fair value through other comprehensive income category for debt instrument, if we sell the debt instrument, then the balance lying in other comprehensive income will be reclassified or transferred to P&L. Alright, that is about financial asset. I have given a simple example here, but anyways we have discussed a comprehensive example that is more than sufficient. Entries initially debit financial asset, credit bank or debit investment, and every year whatever amount you have received you will debit bank and credit financial asset. These two entries can be combined as well. Now we will have a look at cases where transactions are not done at fair value, that is off market transaction. Now what is the meaning of transaction not being done at fair value? Say for example, market rate of interest is 8%. We have issued bonds at, let us say, 5%. Possible. Sometimes what happens is a company may give to its employees discounted rate of interest in case of employee loans, or parent may give discounted rate of interest to its subsidiary, or subsidiary may invest in the parent. Sometimes there may be interest free loans. All of these are off market transactions or transactions that are not done at fair value. Now to understand this, just take a simple case where, let us say, you are someone who has 1 lakh rupees with you. Okay. You are someone who has 1 lakh rupees with you. If you invest it in the market or if you give it to a bank or something, you will earn 8% rate of return. Will you give this money to someone at just 4% or at just some 3%? Generally you will not give, but if there are special relationship, you may give. You may give it to your parents, you may give it to your siblings, to your parents and all, to your siblings and all, you may give at interest free rate also. Alright. So that is possible if there is some kind of relationship. Okay. So what the standard says, or what we need to understand is, if the transaction is not happening at market terms, means there is some other consideration which is flowing into because of the special relationship. So if the transaction is not happening at market terms, market rate is 8%, we are giving at 4%, then what we need to check is, we need to check whether any of these relationship exist. So say for example, there is an employee. We have given employee a loan at 4% versus market rate of 10%, which means we are giving a lower rate of interest to the employee. Alright. Now what the standard says is, if you are giving at off market terms, then the transaction price is not equal to fair value. The transaction price is not equal to fair value. Whatever transaction price you have entered into, or whatever price at which you have entered into the transaction, that is not the fair value. Sir, what is the meaning of this? Say for example, we gave an employee a loan of 1 lakh, okay, for 3 years. So in year 1, we will get interest of how much? If we give at 4%, 4,000. Year 2, how much money we will get? 4,000. Year 3, how much money we will get? 1,04,000. Correct? Correct. Okay. Now, had I given this 1 lakh to somebody else, I would have received 10,000, 10,000 and 1,10,000. I am collecting lesser amount. Now, what we have to check is, if I have to receive 4,000, 4,000 and 1,04,000, and if I have to earn 10% rate of interest, how much amount will I give today? I am repeating the question once again for your understanding. If I will receive a cash flow of 4,000, 4,000 and 1,04,000, and my objective is to earn 10% rate of return, then how much of loan will I give today? Basically, you will say, sir, we will calculate present value at the rate of 10% for all of these cash flows. Whatever is the present value, that is the amount we will give as loan. So if I calculate present value factor at 10%, so what we can do? We can do 1 divided by 1.1, we get 0.909, 0.909, then is equal to 1 divided by 1.1 is equal to 0.8264 and 0.7513. What is the present value? 4,000 into 0.909 is equal to 3636. Then 0.8264 is equal to 3305. Then 1,04,000 into 0.7513 is equal to 7813.52. 7813.5.2. If I do a grand total, I get 85076. So the way you have to understand is, in normal circumstances, for these payments, I would have given a loan of only 85,076. This is the fair value. But how much did I give, sir? I gave 1 lakh. Sir, why did you give extra? How much extra did we give? We gave extra amount of 14,923. Why did we give 14,923 extra? Because there is a employer-employee relationship. So this extra amount that you pay is my employee benefit expense. Okay. Similarly, if there are any security deposit which are made interest free, So the excess amount of deposit means the difference between the transaction price and fair value, that difference is considered to be prepaid lease rent. Similarly, if the parent has given to subsidiary a discounted rate of interest for loan or for preference shares, whatever it is, then the difference is treated as investment, and if subsidiary is giving to parent, the difference is treated as dividend. Means any excess amount you are paying is consideration for something else, not for this financial asset. Alright. Now, actual term used in standard is the difference between transaction price and fair value whenever transactions are not happening at market terms. If it is based on level 1 or observable inputs as per Ind AS 113, then you will take it to P&L. Means if the fair value is determined using level 1 inputs or observable inputs. Level 1 means quoted in the market. Observable means what we can observe in the market. If that is the thing, then we will take it to P&L. Otherwise, we will defer it and treat it as an asset if it qualifies. This is the standard term, this is the terminology that the standard uses. For our purpose, for our exam purpose, we have to check the relationship and account for the differences accordingly. So let's have a look at a question based on this, which will make our life much simpler. Let's have a look at this question. Hill Limited issues 4-year 2,002% redeemable cumulative preference shares of 1,000 at par to its parent Mountain Limited. So, what is the term? 4-year. 2,002% redeemable cumulative preference shares. Now, for preference shares, we have not yet discussed the classification, but whenever we have redeemable preference shares means what? The investor or the holder has a contractual right to demand for payment, and the company has a contractual obligation to deliver cash or another financial asset. So when it is redeemable is treated as financial liability. 2% redeemable cumulative preference shares of 1,000 at par to its parent Mountain Limited. 2% is what? It is the coupon dividend. Now please remember, dividend is not mandatory, but dividend has to be paid if dividends are declared to equity shareholders, right? Now here what we will assume is, whenever dividends are given, it is assumed that dividend would have to be paid. On 1st of April of year 18, market rate of interest is 12%. Show the journal entries in the books of Mountain Limited for all the years. Now what is the meaning of this? Basically, a Hill Limited has issued 4-year 2% redeemable preference shares to its parent Mountain Limited, and we have to account for it in the books of Mountain Limited. Mountain Limited has invested. What is the income they are getting? 2%. If they invest in the market for similar instrument, they will get 12%. So instead of giving somebody at 12%, we are giving it to our subsidiary at 2%. Okay, means one portion we are giving a loan, but we are also passing some additional benefit. How much is that benefit? So what we need to understand here is year cash flow. Year 1, 2, 3, 4. Okay. What is the cash flow? How much will Mountain Limited receive every year? 2% on 1,000 is 220, and 2,000 is the number of shares. So 2,000 into 2% into 1,000. Alright. So 2,000 into 2% into 1,000, 2,000 into 2, 4,000, 40,000 is what will be received. So cash flow is 40,000 for year 1, 40,000 for year 2, 40,000 for year 3, and what is the total investment? 2,000 into 1,000, 2,000 into 1,000 is 20 lakhs. 20 lakhs is the repayment. Okay. Now this is the cash flow received by whom? By Mountain. Now you think of it from Mountain's point of view. If I have to receive 40,000, 40,000, 40,000 and 20 lakhs in the 4 years, how much amount will I invest today so that I will earn 12% rate of return? In that case, what do we do? When we need 12% rate of return, we will basically calculate what should be the present value of these cash flows. Correct? Think logically. If you want to earn 12%, you will see what is the present value of these cash flows at 12%. That is the amount I will invest. Beyond that, I will not invest. So, present value factor at 12%, we can consider 1 divided by 1.12 is equal to 0.8928. 0.8928. See, in the exam, please take the present value factor given in the question, okay. Then is equal to 0.7971 or 0.7972 rounded off is equal to third year 0.711718 is equal to fourth year 0.6355. Okay. Now, I will introduce one more concept here. These are individual year present value. There is something called present value annuity factor. If I total all of this, grand total, I get 3.073, 3.0373, the total of all of this. Okay. Now, what is the present value? 40,000 into 0.8928 is equal to 35712, 35712. 0.7972 is equal to 31888. Please observe, I am not typing the full amount again. I am just saying 0.7118 is equal to 28472. So, when one side is same, I just need to change the present value factor. Okay. Then lastly, it is 20 lakhs into 0.6355 is equal to 1271000. What is the grand total? 13 lakhs 67,072. This is present value of cash flow. Now the company, that is Mountain, has contractual right to receive these cash flows. So, this present value of cash flows represent the investment in preference share or a financial asset. That much is the financial asset. If I have to earn 12%, this 13,67,072 is the amount that I have invested in the subsidiary as preference shares or as debt given. Please remember, preference shares which are redeemable, and in India preference shares are redeemable in nature, preference shares which are redeemable are considered to be financial liability. Preference shares which are redeemable are considered to be financial liability. So, this investment in preference share is basically, for the investor it is a financial asset, for the subsidiary it is a financial liability. Okay. Now what is the total consideration here? Total consideration is equal to 20 lakhs. Okay. Parent has given 20 lakhs to the subsidiary. The cash flows present value is only 1367. So, this is the amount of financial asset where you have a right to receive cash. The balance amount is what? Balance amount is equity contribution or investment in subsidiary as equity. So, excess minus 20 lakhs 632928. This is investment in equity. Okay. Now, the interest income will be recognized on 13,67,000 at 12%. At the end of 4 years, we will receive back 20 lakhs. So, this part will be closed. This 632,928 will remain as investment in subsidiary. See, both are investment. One is in the form of loan given. The second one is in the form of equity contribution. Okay. So, 20 lakhs and 632. 1392. Oh, I took only 20 lakhs in the last year. See, a mistake, a silly mistake here. This should not be 20 lakhs. This should be 20 lakhs 40,000. This should be 20 lakhs 40,000 and you will get to the answer as we have done. Now, I told you, right, I will do it on present value annuity factor basis also. So, here what happens is, whenever you have same amount being paid every year. Now, here what is the same amount being paid every year? 40,000 for 4 years. So, present value can also be calculated as, for dividend, 40,000 into present value annuity factor of 12% for 4 years, and preference share amount 20 lakhs into present value factor for 12% for 4th year. Okay. So, this will be equal to how much? 40,000 into present value annuity factor 3.0373. So, that is equal to 40,000 into 3.0373 0373, that is 121492, 121492, and here it is present value factor means single year factor 0.6355, 0.6355. So 20 lakhs into 0.6355 is equal to 1271000. What is the total? Plus 121492, total is 1392492, 1392492. So here I made a mistake here, right? It's not 1367, it is 1392492. So the present value of the cash flows comes to 13,92,492. This will be your investment in preference shares, and balance amount will be investment in equity. Okay. So 1392, here we got 492, here we got 496, that's just because of rounding of differences. Alright. So the financial asset at amortized cost will be present value of cash flows, and additional investment in subsidiary equity is 6,07,000. Now how do we interpret this? See, the parent has given a total amount of 20 lakhs. If I want to earn 12% for the given stream of cash flows, I will give only 13,92,000. So this part represents my investment in preference shares. The extra amount that is paid is basically investment in equity or equity contribution from parent to subsidiary. Now in such kind of scenarios, what we will do is, we will take 13,92,496 and prepare our amortization table. Okay. So when we prepare our amortization table, we will maintain it at 12%. So opening balance 13,92,000. Interest at 12%, 167,100, dividend 40,000, closing balance 15,90,596. Okay. Last year you have to consider for balancing figure. Alright. So 1392, how do we calculate? 13,92,496 into 12%, 167099 or 166711 plus is equal to minus 40,000. You get the closing balance. Then again into 12%, you get 182,352 plus is equal to minus 40,000. Right. Then again into 12%, 199,434 plus is equal to minus 40,000. Like that when you do, you will get the closing balance. Now we don't call it dividend, we call it interest. Dividend is only on those instruments which are classified as equity. Preference shares are not classified as equity, so our will be interest income at effective rate of interest. Amount received will be based on 2% coupon only. So every year, first year P&L will be 167,100 income, that is how you will recognize. Now what are the journal entries? First, investment in preference shares 13,92,000, investment in subsidiary equity 6,07,000. Then when we receive money, how much amount will receive? Bank account debit 40,000. To income or to P&L 1,67,100. See here 1,67,100. The balance amount, see 40,000 we receive, which our income is 167. The balancing amount is debited to investment in preference shares. Then second year same way, finance income 182,352 from here. Amount received how much? 40,000. Balance amount investment in preference share. So investment bank to financial income to bank account, like that we can do. Alright. So far what we have done, financial assets we have completed. If transactions are happening at off market terms, that also we have done. Now we will move on to classification and measurement of financial liability. As far as financial liabilities are concerned, either we will follow amortized cost method or fair value through P&L. For amortized cost method, similar to the way we have accounted for financial asset, same logic will apply when we follow the amortized cost method. This will be largely for your liability having your principal and interest portion only. Rest all will be measured at fair value through P&L. If it is held for trading, okay, for avoiding accounting mismatches, for derivatives, all the categories will go as fair value through P&L only. Okay, simple thing. Now, another concept which is very important is compound financial instrument. Sir, what is compound financial instrument? Now, let us say we have convertible bond. So, a company has issued convertible bond, 1000 bonds of face value rupees 100 and at interest rate of 8%. Okay. This can be converted to equity at the rate of 1 share per bond. So here there are two components. This is also called as an embedded feature or embedded derivative. Okay, embedded means there is a main contract, there is a small another contract which is attached to the main contract, that is called embedded. So here there is an embedded derivative because this can be converted. So there is a conversion option. So whenever we have convertible option, it takes the form of, or it takes the nature of a derivative. Okay, but that's slightly in-depth discussion. We don't need to worry so much about for our examination perspective. So if there is an option to convert the debenture into equity shares, means what happens here? Here there are two streams, stream 1, stream 2. In the first stream, you have 1000 of face value 100 and interest at 8%. So here there is an obligation to pay principal as well as interest. Every year interest at 8% should be paid, and not only that, at the end of it the face value must be redeemed, maybe at par or at premium, but there is a contractual obligation to deliver cash, that is by way of interest and principal. Now, if the other party, the investor, comes and says, no, I don't need redemption at the end of 4th year or 3rd year, please give me equity shares. Please give me equity shares. Now here tell me, are the number of equity shares fixed? Yes. Is the consideration fixed? Consideration is already received, that is also fixed. So second stream takes the nature of equity. Second stream takes the nature of equity. First stream takes the nature of financial liability. From the company's point of view, they have a financial liability to pay interest and principal. They have a liability to pay interest and principal throughout the period of the bond. That is a financial liability component, and apart from it they have a equity component where they have to issue shares if at all the other party says, okay, I want shares. Alright. So these kind of instruments where you have a liability component and an equity component is called compound financial instrument. What is it called? Compound financial instrument. Wherever we have a liability component and an equity component brought together, we call it compound financial instrument. Alright. So what is a compound financial instrument? The instruments which have feature of both a financial liability and equity instrument are compound financial instrument. Okay. Now please remember, accounting for financial liability and equity is different. Equity is initially measured at cost. After that it is not remeasured. This financial liability, because there is principal and interest, we will follow our method called as amortized cost method. Right. So how do we do the accounting? That is what we need to understand. Convertible bond is having 100 rupees face value and giving us interest of 8%, plus there is an option to convert into shares. Now tell me, if someone is giving us an option to convert, okay, if someone is giving us an option to convert, let us say you are that person, you have got an additional option, means you are getting extra benefit. If I remove this option from this instrument, I will tell you that, okay, take this option away, I will not give you this option, then will you still agree at 8%? You will say no. Why? Because you have removed one feature. I need more interest to compensate for removal of that feature. Right now what is the scenario? If equity is beneficial to me in the future, I will convert that into equity. So that is beneficial for me right now. So I am agreeing at 8%. But if you are saying that no, I will not give you 8%, but if you are saying that I will not give you that option, you will not agree at 8%. You will say, please give me higher, maybe give me 10% or whatever is the rate in the market. Okay. Now to solve this kind of question, what we do is, we compute first present value of cash flows for financial liability at market rate. Now if 8% cash flows is discounted at 10%, will it be higher or lower value? If you increase the discount rate, always remember the value will be lower. So you will get some amount. There will be total issue value, let us say 1000. From that you will remove this present value of liability, the balance number whatever you get will be equity. Okay. Now to this also you solve using a question, you will have a better understanding. G Limited issued 6% debentures of total 10 lakhs on 1st of April, repayable on 31st March of 22. So 18, 19, 20, 21, 25 years. The debentures holders have a right to receive equity shares of face value 4 lakhs at maturity as alternative to repayment in cash. Okay, so at maturity date, you can get 4 lakhs worth or 4 lakhs face value of shares. Sir, is the number of shares fixed here? See, 4 lakhs face value is fixed means if the face value is 10, number of shares are fixed. We are not saying 4 lakhs worth of shares. What we are saying, 4 lakhs face value of shares. So, number of shares are fixed. The required rate of return is 10%. How the transaction will be accounted? So, here they are paying a 6%. If this option is not there, we will get 10%. How should we account for it? Now, here there is a compound financial instrument. There is a debenture and there is a convertible option. So, what do we do? Step 1, present value of principal plus interest for financial liability. Okay. Now, here we will not do step by step. We have understood how to use present value annuity factor. Okay. So, one is interest, second one is principal. How much interest is payable? 10 lakhs, 6%. Payment will be 10 lakhs into 6%, face value into coupon. So, 10 lakhs into 6% is 60,000. We need present value factor or present value annuity factor. At what rate? 10%. Now, 60,000 is received for how many years? 5 years. Take your calculators, 1 divided by 1.1. We will always discount using market rate, effective rate, required rate. We will not discount using coupon rate. Is equal to 0.909, 1, 2, 3, 4, 5. 0.6209. So, 5th year principal that we will get 10 lakhs, no? Yeah. Principal that we will get 10 lakhs, the present value factor is 0.6209. Now, one thing all of you please keep in mind, here I have taken 10 lakhs. Sometimes in the question they may say redeemable at premium. You have to take the amount at which it will be redeemed, cash flow. And if I do GT, I get 3.7907. 3.7907. So, what is the present value? Present value is into 60,000. 227447. 227447. And here it will be 6,20,900. Plus 620,900, we get 848347. 848347. What is this? Present value of cash flow, which represents financial liability. Total proceeds 10 lakhs. The balance represents equity minus 10 lakhs. You get 151652. 151652. So, this is financial liability, this is equity. Sir, why did we discount using 10%? Had we issued normal debentures for these cash flows, we would have received only 8,48,000. The extra amount that we have received represents the equity component. So, how will the original accounting be? Bank account debit 848347. Oh, sorry. Bank account debit 10 lakhs. 2. Debentures, financial liability 848347. 2. Equity 151652. The table will be prepared using 8,48,347 only. Okay. So, here we got 8,48,342, again 5 rupees difference because of rounding off. Table will be prepared using 848,342, or in our case how much did we get? 848,347. Okay. In exam, when you use the discounting factors given in the question, there will not be a problem. Then multiply this with 10%, that 84,834. Amount paid 60,000, we will pay 60,000. Closing balance, opening balance plus interest minus coupon paid, closing balance plus interest minus closing balance. Okay. You go closing balance 873,176. Next period 873,176 into 10% minus 60,000, 9,04,94. Like this, when you do, last year you will use this balancing figure, closing balance will be 0. Okay. Every year we will recognize interest expense. So, first year entry will be for interest expense debit 84834 to bank. We have paid only 60,000. Balance will be to debenture financial liability. How much? Whatever is left, 24834. Like this we have to do the accounting. Initial entry we did bank account to 6% to equity component, this we have done. Then finance cost to bank to debenture liability component. Okay. So like that we will do. Now what will be the closing balance of liability in the balance sheet at the end of first year? 873,176. What will be the balance of loan equity? 151. This will continue to remain at 151,658. Okay. So this will remain at 151,658. P&L will be so much. Alright. Now what happens at the end of the fifth year? At the end of the fifth year, if it is redeemed, then I will do it from here. If it is redeemed, then it is the entry that we will pass. But if it gets converted into equity shares, then what we will say? We will say debentures. Whatever is the percent? 6% debentures account. Debit. How much? 10 lakhs. This debenture balance we will use to issue equity shares. So this will be transferred to equity share capital account. But not only this, we had that equity component, no? We had that equity component, right? That account also we have to close. That equity balance, whatever was there, which was recognized initially, even that will be used to issue the equity share, because that was the equity component we had recognized. Against that we are issuing equity shares. So what is that amount? That amount is 151,658. 151,658. 2. Equity share capital face value 4 lakhs given in the question, and the balance amount 11 minus 4, 7 lakhs 51,658. That will be your securities premium account. In some cases in the study material, also in the past exam papers I have seen, they have not considered this component, which is incorrect. You have to consider this component as well. I hope it is clear. Same way, next question, convertible debenture, you can convertible bond, same concept applies. I will just show you quickly how to calculate the present value of liability. After that you will be able to pass the remaining entries on your own. 2000 convertible bonds at the start of year 1, they have a 3-year term and are issued at par with a face value of 1000 per bond, giving total proceeds of 20 lakhs. Interest is payable annually at 6%, convertible at any time up to maturity for 25,000 shares. When the bonds are issued, the prevailing market interest rate for the debt without the conversion option is 9%. They elected to convert, right? So here what will happen? You need to calculate what is the interest payable. Interest is 2000 into 1000, 20 lakhs. 20 lakhs into what is the interest rate? 6%. So please be careful, 6%. So 20 lakhs into 6%, what is the interest you will get? 1,20,000. This is for 3 years at 9%. So 1 divided by 1.09 is equal to 1, 2, 3. Third year factor for principal is 20 lakhs. Principal will be paid, right? 20 lakhs into 0.7721. Okay. And grand total if we do, we get 2.5312 into 1,20,000. 303,755. 303,755. And here it is 20 lakhs into 0.7721. 1544200 plus 303,755. 1847955. So this is the liability component. Now if you do individually, you get 1848. The reason why I got difference here is again for examination purpose, please keep that in mind. I have used your 2.5312, but if I total this 0.9174 plus 0.8417 plus 0.7722, I get 2.5313. 2.5313, and that single decimal will make a difference of whatever around 200 ka jo difference whatever we have got. Okay. So in exam when they have given you the factors, use the factors, or else you can use the annuity factors as well. After this, balance amount is equity. Prepare the table using liability, and remaining things you can pass. Here again, convertible bond 20 lakhs, equity component 151, to share capital and to securities premium. Entire amount you have to consider. Alright. Now the next one, again same concept. Moon Limited issues 1,08% debentures of face value on par basis on 1st of January. They are redeemable at 12% premium at the end of 26 or exchangeable for ordinary shares of Moon Limited on 1:1. So there is a conversion option. Okay. Interest rate for debentures that do not carry conversion entitlement is 12%. Now they have given discount factor of 8% and 12%. What will you consider? You will consider 12% for discounting purpose. Okay. Then you can do the total and do it. For example, 0.893 plus 0.797 plus 0.712 plus 0.636, annuity factor is 3.038. Okay. So how much is the interest? Interest is 8% on 100, 8 into 1 lakh, 8 lakhs into 3.038. Principal 1 lakh into 100, 1 crore into 0.636. So this will be equal to into 8 lakhs 243,0400, and this will be 63 lakhs 60,000 plus 63 lakhs 60,000, 8790,400, 8790,400. Okay. So I am doing this part again. So we get 3.038. So interest is how much? 8 lakhs. Interest into 3.038, 8 lakhs into 3.038 is equal to 2430400. Principal, how much is principal? 1 lakh into 100, 1 crore, but please remember redeemable at 12% premium. So 1 crore plus 12%, 1 crore 12 lakhs, 112,12123. Into 0.636 is equal to into 0.636 is equal to 7123,200 plus 243,0400, you get 95 lakhs 53,600. What is this? Present value of liability. That is present value of liability 95,53,600. Only thing you have to keep in mind here is there is a premium of 12% at the time of redemption. Okay, here how much did they get? 95,53,600. So what I am trying to tell here is whether you do one by one or whether you total it up and do, it is the same thing. To save time, you can do it this way also. Now what does this 95,53,600 represent, students? This represents my present value of liability. My table I will prepare based on 95,53,600 only. Okay, here they have not asked the table, they have said you are required to calculate the value of debt portion and equity portion, the balancing number, and show the journal entry at the inception. So journal entry at inception is simple. Amount received in bank 1 crore, 8% debentures debt component, financial liability 95,53, equity component 4,46,400. Alright? Okay. Let's have a look at the next question. This is from a past exam paper, compound financial instrument. Okay. Though the suggested answer is not correct, I would say 100%. Still, I will give you both the versions that will help you understand what is the right approach and what you can do in the examination as well. At the beginning of year 1, Black Paper Tulsi Limited issued 40,000 convertible debentures with face value 100 per debenture at par. Okay, how many debentures? 40,000 into 100. The debentures have 6-year term. Interest at annual rate of 9% is paid half yearly. Okay, so 9% is the interest coupon payable half yearly. How much will this be into 9% if I do? So I have 40,000 into 9%, that will be 4,000, 3,600 and 2 more zeros. Okay, this is the annual interest, but it is paid half yearly. So what you will do? You will divide it by 2, you will get 1,80,000. Every 6 months 1,80,000 of interest is payable. Alright. The bondholders have an option to convert half of the face value of debentures into 2 equity shares at the end of year 3. So please see this timeline. We are year 0, year 1, year 2, year 3. Every 6 months, okay? Every 6 months interest will be paid. How much? 1.8 lakhs. 1, 2, 3, 4, 5, 6. From here till here, every period or every 6 months interest is paid 1.8 lakhs. Now, one logic of discounting and interest computation, compounding, everything, whatever you learn about, yearly 3 payments, when we will discount it by 3 periods. Now here we have 6 payments, 1, 2, 3, 4, 5, 6. So when we have to do the discounting, we will discount considering 6 periods, not 3 periods. So whenever payment is happening half yearly, the number of payments will be twice, interest rate will be half, and discounting will be for the number of periods or number of payments. Okay. Right. Now what are they saying? Half of the face value of the debentures, 100 is the face value, 50, how much? 50 face value of debentures can be converted into equity shares. The bond holders not exercising the conversion option will be repaid at par to the extent of 50% per debenture at the end of year 3. Basically we have collected 100, not collected 100, we have issued 100 of face value. This has 2 parts, 50, 50. 150 will be repaid or converted into equity shares at the end of year 3 or at the end of 6 periods. The remaining 50 will continue from this period till the end of 6th year. The non-convertible portion, see they are saying, so there is one convertible portion, there is one non-convertible portion at 10% premium will be repaid at 10% premium at the end of year 6. So what is the non-convertible portion? 50 into 40,000 into 1.1, 10% premium is what we are paying. So 40,000 into 50 into 1.1, you get 22 lakhs. How much will be paid here? End of year 3, either you pay or convert, you will get 20 lakhs. 20 lakhs will be repaid or converted. Okay. Clear? Fine. At the time of issue, the prevailing interest rate for similar debt without the conversion option was 10.25%. Required compute the value of embedded derivative. Sir, what is this embedded derivative? I told you, right? Embedded derivative is nothing but there is a contract, main contract, which we call as a host contract. In that you have added one derivative option. So this conversion option is a derivative option. The conversion option is a derivative option. So basically what they are saying, they are asking us to find the value of the equity component in the overall instrument. Now 2-3 things that you remember. One, they have said 10.25%, the market rate. Typically when you have 10.25%, they have not said whether it is per annum basis overall or is it 6 monthly compounded. Basically, is it annually compounded or 6 monthly compounded? Because if this is an annual compounding, what you will do, you will divide it by 2 and do the calculation. But if it is 6 monthly compounding, we have to derive what is the rate of interest for the first 6 months. That is one issue. Pass the journal entry at initial recognition, annuity factor of 5% for 6 years is so much, 12 years is so much, 5% for the 12th year end is so much. So they have given us 5% factor. So this is an indication that this 10.25% is not annually, it is 6 monthly compounded. How do we do that? I will tell you. So when we say compounding, if you have 100 today and rate of interest is 10% per annum, but it will be compounded 6 monthly. Okay. So for first 6 months, how much will you get? 5%. You will get 5, 100 plus 5 will be 105. Then again you will get 5%. So 105 into 5% is 5.25. So at the end you will have 110.25. So the effective rate will become 10.25%. So if it is 10% compounded every 6 months, effective rate will become 10.25%. There is a formula to derive this, that is rate is equal to 1 plus r to the power of n minus 1. What is the rate? 10.25% is equal to 1 plus r we do not know to the power of 2 minus 1. So 10.25% is nothing but 0.1025 plus 1 is equal to 1 plus r to the power of 2. 1.1025 is equal to 1 plus r to the power of 2. Correct? No need to do it in the exam, okay? It is only for your understanding. So 1 plus r is equal to square root of 1.1025. 1.1025 square root, I get 1.05. 1 plus r. R is equal to 1.05 minus 1, that is 0.05 or 5%. So basically, because they have given us 5% here, we can directly see that 6 months period is 5%. Also they have said, see, for 6 years, we need how many periods? 1, 2, 3, 4, 5, 6 periods. 12 years, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Next 6, previous 6. So that is the indication that we have to use 5%. Another thing is 1.05 into is equal to, you get 1.1025 minus 1 when you do, you get 0.1025. Alright. Okay. So what is the discounting factor? 5%. Discounting factor is 5%. Now, how do we solve this? Whenever we have a compound financial instrument, we have to calculate the present value of liability without the conversion option one side, and the balance amount will be the equity component. That is what we have been doing. So we have to see that if the conversion option is not there, what will be the present value of liability. Now if the conversion option is not there, what will happen? From year 0 to year 3, first 6 period, you will pay 1.8 lakhs of interest. After that the interest will be half, because half the principal is given back. Here you will have 90,000 of interest. If it is not converted, at the end of year 3 we will pay 20 lakhs, and at the end of year 6 we will pay 22 lakhs. So we need present value of all of these items. Alright. So present value of liability component with no conversion option. With no conversion option. What is there? First, for year 0 to 3, number of periods 6, interest 1,80,000, interest or principal. Okay. And present value annuity factor, for 5% for 6 years, 6 periods. Okay. So whether it is 6 years or 6 periods, the number is same. Why 6 periods? 6 times interest is being paid. How much is that? 5.076. 5.076. So what is the present value? 1,80,000 into 5.076. The present value is 9,13,680. This is the first thing. Then for year 4 to 6, how many periods? 6 periods. What is the interest paid? 90,000. Okay. What is the present value annuity factor? Now they have given present value annuity factor for 12th year. Like 12th year, how much is that? Sorry, 12 years, 8.8863. Have they given us annuity factor for 6 to 12? No. But with annuity, how it works is present value annuity factors of 1 to 6 years plus present value annuity factor from 7 to 12 is equal to present value annuity factor of 1 to 12. Alright. So if I need this, basically what I need to do, present value annuity factor from 7th period to 12th period is equal to 8.863 minus 5.076. 8.863 minus 5.076. 3.787. 3.787. So what is the present value? Into 90,000, present value is 340,830. Present value is 340,830. Okay. This is the interest component. Then principal, if it is not converted, end of 3 years, how much will we pay? 20 lakhs. What is the present value factor? It is not given in the question. 1 divided by 1.05 is equal to 1, 2, 3, 4, 5, 6, 0.746 into 20 lakhs, 1492430, and end of year 6, 22 lakhs. Factor given is 0.557. 0.557. 0.557 into 22 lakhs, 12 lakhs 25,400. So what is the total? Plus 1492,430 plus 340,830 plus 913,680 is equal to 39,72,340. 39,72,340. 39,72,310, that 30 rupees is because of rounding of difference. Okay. 746,2. Oh, I took 7,462. Okay, so that is the difference. If we take 746, we get 1,492,430. 1,492,430, and it will match. Alright. This is what? This is present value of liability. What is the total proceeds? total proceeds is 40 lakhs. Equity is minus 40 lakhs, 276. Equity portion is 27660. Actually, no, 27660. Liability, equity and total. Alright. Sir, but why have we considered this end of year 3 20 lakhs here as being paid? See, whenever we have to calculate the present value of liability, we have to consider what is the present value of liability if conversion option was not there. Also remember, in this question they have said two portions, convertible portion, non-convertible portion. How do we calculate the present value of liability for convertible portion? We assume that it has not been converted. That is the present value. Non-convertible portion, again we will see what is the present value, and accordingly we will do it. Okay. Now another way to work it out or calculate this is, especially the interest part, 90,000. So there are two parts, no? 100 mein you have 50. 50. This is outstanding for 3 years, this is outstanding for 6 years. So on first 90,000 you will apply 5.076 as the present value factor. Second 90,000 you will apply 12 years. So on this 50 you will pay for 12 periods, here you will pay for 6 periods. So if you do 90,000, 8.863 and 5.076. 5.076 and 8.863. Sir, what are you doing here? Basically what I am doing, 100 I am splitting into two parts. 50 for which I will pay interest for 3 years, and at the end of 3 years either I will convert or redeem, and balance 50 which will continue for 12 periods. Okay. So 90,000 into 5.076 m plus 90,000 into 8.863 m plus MRC if I do 1254510. So if you do the total here, you will get the same number, minus 913680, you get 340830. Okay. So basically present value of interest for 50 face value, present value of interest for another 50 face value, one for 3 years, one for 6 years we have computed, and this is the liability. Now what the search answer has done is, they have not considered the repayment obligation at the end of year 3 and computed the value of liability as sum of these three, which is incorrect. Okay. That is incorrect. Why? Because there are two streams, and we know that the present value of liability is present value of cash flows considering that the conversion option is not exercised, right. That is how we have to calculate. Alright. Then in the workbook we have a convertible bond. This you can calculate. It is again the same concept, some questions you can practice. Alright. Let us look at the next question. On 1st April, V Limited issues convertible bonds worth 50 lakhs. These bonds have a tenure of 5 years with a face value of 20 each and carry an annual interest rate of 5% payable at the end of each year. So how many? 50 lakhs, face value of 20. Okay, they have not said whether they have issued at par or these bonds have been issued at face value, and each bondholder has the option to convert their bond into one ordinary share of V Limited at any time within the 5-year period. So at any point of time within the 5-year period they can convert. Okay. The comparable companies with similar risk profile have recently issued non-convertible debt at 7%. So this becomes my discounting factor, discounting rate, similar terms, right. Now 50 lakhs, how many bonds are there? 50 lakhs divided by 20. So 50 lakhs divided by 20 means 2,50,000 number. 2,50,000 bonds have been issued. Okay. What is the coupon? Coupon is 5%. So 50 lakhs into 5%. 50 lakhs into 5%, again it is 2,50,000. Interest also is 2,50,000. Okay. And it is a 5-year bond. Alright. And discount factor is 7%. So how will you do? We will calculate present value interest. How much? 2,50,000. Principal has the option to convert. So if they don't convert, we have to pay them 50 lakhs. Okay. Present value factors, 1 divided by 1.07 is equal to 1. 1, 2, 3, 4, 5, 0.7129, 0.7129, 298 is actually 30. 7130, okay, and grand total 4.100, 4.100. Present value is into 2,50,000, 10,250,49, 10,250,49 and 50 lakhs into 0.7130 is 35 lakhs 65,000 plus 10,250,49 is equal to 459,0049, 459,0049, alright, and issue value is how much? 50 lakhs. So, this is liability, equity minus 50 lakhs, 49,951, 49,951. Now, what is the question? Pass the journal entries for the initial recognition of the bond. Initial recognition of the bond means what? Bank account, liability component, equity component. 410. So, that is again, depending on how many decimals we take, the answer will change. Okay. Again, in the examination, because we will use the same present value factors, answer will not be different. Okay. So, here it is 410019 and what we computed 409951, some 60-70 rupees difference is there. Alright. Then, when we prepare the table, how will we prepare the table? We will prepare the table at 7%. So, opening balance, interest, payment, closing balance, like that we will prepare the table. All of us are aware of it. Now, here what is the question saying? Determine the interest expense for each of the 5 years. We have done. Provide the accounting treatment if the bondholders choose to convert their bonds into ordinary shares at the end of 4th year. Now, when this kind of scenario happens, when you are converting it into equity shares at the end of the 4th year, what you need to do is, in this table, what is my 4th year closing balance? 49,06,544. This plus what was the equity we had recognized? 410,019, 410,019, 49,06,544 plus 410,019. This is the total amount. That is 53,16,563. This is the total value for which shares will be issued. So, basically you will debit the debenture account by this, you will debit the equity account by this, transfer that to share capital and securities premium. Sir, how much will go to share capital? Let us see. 1 ordinary shares, okay, they have not said face value. What is the face value? That face value information is not available. So, because the face value information is not available, we will have equity share capital plus security premium 53,16,563. So, we will debit the debenture account and we will also debit the equity account and transfer it to this. Sir, what if they convert it at the end of the 5th year? Then we will take 50 lakhs. 3rd year we will take 48 lakhs 19,000. Whenever the conversion happens, the closing balance of liability will be debited and transferred to equity share capital plus securities premium. Not only that, the original equity will also be transferred to equity share capital and securities premium. Let us have a look at the next question. On 1st of April of 18, X Limited issues convertible bonds amounting to 1.2 crores. These bonds have a maturity period of 8 years, face value of 10 each, annual interest rate of 5.5% payable at the end of each financial year. 1.2 crores, face value of 10 each and 5.5. So, 1.2 into 5.5, 1.2 into 5.5%. 6.6, that is the amount of interest that is payable, okay, every year. The bonds are issued at face value and each bondholder has the option to convert their bond into 1 share of X at any time. Debt instrument with similar risk terms without conversion option have recently been issued at a rate of 8%. This is the discounting factor. The company incurred 10 lakhs as issue cost, increasing the effective interest rate to 9.45%. Now, whenever issue costs are incurred. Issue cost means if I have to make issue of equity shares or if I have to make issues of debentures, whatever it is, I have to incur certain cost. The legal fees would be there, the stamp duty would be there, registration fees would be there, filing documents with ROC, SEBI, so many things are there. So, the cost is 10 lakhs. Now, please remember, as per Ind AS 109, whenever we have some transaction cost, the transaction cost will also be considered as an interest expense only as up. So, the entire interest expense, transaction cost, processing fees, everything put together, you will have a single interest expense or finance cost. Now, if I am paying extra, my interest of 8% will be higher. See, market rate is 8%, I am paying 10 lakhs extra. If I am paying 10 lakhs extra, my effective interest rate will be higher. So, the effective interest rate has now become 9.45%. Now, there are two rates, 8% is the market rate and 9.45% is effective interest rate. Now, what is the rate that we should use for discounting purpose? Please remember, first calculation of liability, we will always consider 8%. We will consider 8% to calculate what is the liability and equity component. Then what we will do, this 10 lakhs of transaction cost, we will split between liability and equity. So, the transaction cost will be allocated between financial liability and equity in the ratio of their gross carrying values. Okay. Right. So, this 10 lakhs will be split between these two. Now, when we split this 10 lakhs, the liability component, the effective interest rate applicable will automatically be 9.45%. Alright. Then, pass the journal entries in the books of X Limited from 1819 to 2122, interest expense for each of the 8 years, accounting entries if they opt to convert their bonds into shares at the end of 4th year after receiving the payment. First, what is the present value of liability? Present value of liability, cash flow is 6.6 lakhs. We will take present value annuity factor at 8% and do the calculation. Okay. Now, how will that be done? Interest, present value of interest is equal to 6,60,000 into, what is the factor? 8%. 1 divided by 1.08, 1 time, 2, 3, 4, 5, 6, 7, 8, 0.54026, 0.5403. Principal is equal to 1 crore 20 lakhs into 0.5403. Grand total 5.7466. 5.746. There will be slight rounding of difference. Okay. Sir, how to avoid that rounding of difference in the exam? The present value factors, whatever is given, you can just total them up. So 5.7466 into 6,60,000 is equal to 37,92,756, and 1 crore 20 lakhs into 0.5403 is equal to 6483600. See, the material also they have taken full values and done the calculation. Okay. Anyways, plus 3792756 is equal to 10276,356. 10276,008, 300 difference, it's okay. Alright. So, this is what present value of liability. Now, this is without considering what? This is without considering the transaction cost. Out of this 1 crore 276 out of 1.2 crores, what is the equity component? Minus 1 crore 20 lakhs if I do, I get 17 lakhs 23,644. This is equity, this is liability. Now, what we have to do is that 10 lakhs what you have incurred, right? That 10 lakhs you have incurred for 120, correct? The 10 lakhs we have incurred for 120, that 10 out of 120 we will multiply with the liability component and the equity component to split the cost. I am repeating once again. On a total proceeds of 120, see 102 plus 172, total is 120, right? On this 120 we have incurred 10, this 10 we have to split in these two ratios. So, what we will do, 10 divided by 120, 10 divided by 120 into 10276,008. We get 8563333.9. 856,334. How did we get that? Once again, 10276 plus 1723 is 1 crore 20 lakhs. On 1 crore 20 lakhs, we have incurred 10 lakhs of transaction cost. This 10 lakhs of transaction cost should be split between liability and equity in the ratio of 102 and 172. Now, this 102 and 17 whatever we see, what is the total of this? 120. So, how do we do that? Take 10 lakhs, divide by 1,20,000, multiplied by 10276. You get 856,334 and 143,666 here. So, you will take total proceeds. Top you will take transaction cost into liability component into equity component. Alright. Now, on liability we got 10276, we incurred transaction cost of this. So, what is our net amount? 9419,674. Sir, why did we reduce the transaction cost? See, I have issued shares. I collected 1 crore 20 lakhs. I incurred 10 lakhs. What is the net amount I received? 120 minus 10, that is 1 crore 10 lakhs. So, same way from liability and equity I will discount. Okay. Now, sir, can I discount all of these cash flows using 9.45%? Yes, that also you can do, but that will not give the correct picture in terms of calculation and also for working notes for examination. So, better discount by 8% and then split the transaction cost in the ratio of their gross carrying amounts. I hope it is clear. Alright. Now, what is the original entry? Bank account debit 1 crore 20 lakhs to convertible bond liability component 102, convertible bond equity component 1723. Then, for the cost, convertible bond liability component 856, convertible bond equity component 143, to bank 10 lakhs. So, basically what we have done, credited here, debited here. Sir, can we pass a combined entry? Yes, you can pass a combined entry as well. Alright. Then, the table for liability will be prepared using 9419674 at an effective interest rate of 9.45%. Sir, why did we increase the effective interest rate? See, whenever there is a transaction cost incurred, my interest cost will be higher, my effective interest rate will be higher. That is why I have used 9.45%. So, the table that we will prepare will be based on 9.45%. Payment will be based on original rate only. So, at the end of the 8th year, you will reach to an amount of 1 crore 20 lakhs. Okay. Now, what they have said, prepare the entries if they convert to bonds into ordinary shares at the end of 4th year. So, at the end of 4th year after receiving interest, 4th year means 104,79,335. So, what we will do? We will debit the liability by 104,79,335. We will debit the equity that we had initially recognized 15,80,326, right, to share capital and securities premium 120,59,661. So, a very good comprehensive question having transaction cost and conversion option, which you should definitely practice. Okay. So, with this we have seen how to calculate an account for compound financial instrument. Always keep in mind discount at market rate of interest, present value of liabilities, present value of principal plus interest at market rate of interest. If there is transaction cost, allocate between liability and equity in the ratio of their fair values that we have determined. Okay. Any questions, please feel free to drop a comment and ask. After this, we will cover the remaining small portions and small concepts in this particular chapter. Let's now have a look at the next question, a very simple question. Bees Limited borrows a sum of 20 crores from Sindhu Limited on 1st of April, repayable as a single bullet payment at the end of 5 years. Single bullet payment means what? At the end of 5 years, principal amount will be paid back in lump sum. Versus if you make equated payments or equated annual payments or installment basis, principal will be repaid after every installment or along with every installment. The interest thereon at 5% is payable at yearly rest. Since the market rate of interest is 8%, okay, now what has happened? The rate being charged is 5%, market rate of interest is 8%. Now tell me one thing, will someone give you a loan at 5% when the market rate is 8%? They will not give, okay. So there will be some other form of either consideration or some other form of relationship. Bees Limited paid an origination fee of 2.3954 crore to Sindhu Limited to compensate for the lower rate of interest. Now let us understand this. B has borrowed from Sindhu. So we have B, we have Sindhu. B has borrowed from Sindhu how many crores? 20 crores. Now to compensate for the rate of interest, what did B do? B made an upfront payment of how much? 2.3954 crores. So can I say the loan amount is 20 minus 2.3954? That is 17.6046. Can I say this is the net transaction price? See, if I take 100 from you and if I give you back 10 immediately, what is the net amount of cash flow? Only 90. So, in effect, what they have done, they have taken a 17.6046 of loan, so that though you are paying interest at 5% on 20, but your effective rate of interest becomes 8%. Sir, why did effective rate of interest become 8%? Because the net loan amount has actually come down to 17 and you are paying 5% on 20, that is 1 crore of interest every year and 20 crore at the end of the 5th year. 5 years only, no? Yeah, 5 years, right? So, if you want to check, it's only for a checking and understanding. How much is interest? Interest is 1. Principal is how much? Principal is 20. How did we get 120 into 5%? Okay. Now, this into present value annuity factor of 8% for 5 years and this is present value factor at 8% for 5 years. 1 divided by 1.08, 1 time, 2, 3, 4, 5. We get 0.6805. How much? 0.6805 and grand total we get 3.9927. So how much is this? 3.9927 and 20 into 0.6805, this is 13.61 plus 3.9927, 17.6027, 17.6046 is here, 27 is here, that is because of rounding of difference. So basically what happens, if I discount the cash flow of 1 crore of interest and 20 crore of principal for 5 years at 8%, I get the present value of 17.60. This is the fair value. But because I have taken a loan of 20, B has taken a loan of 20, what as I said, you pay back 2.3954 maybe as processing fees, alright, 3954, okay. There are no other transactions between the two parties. Calculate the amount at which B's will recognize the loan and recognize the annual interest income thereon. Now here please remember, they have given interest rate, a discount rate of 5% and 8%, but as I told you earlier, if the transaction amount is given 20 crores and transaction cost is given, we will recognize it at 20 minus 2.3954. If you want, you can use 8% discounting rate and check, that is also okay, but original initial recognition will be at that value, that is 17.6046. Interest on this at the rate of 8% will be applicable. Okay. So this schedule we know how to prepare, you can prepare it. Let us look at the next question. Now the questions that we are discussing are more of a recap of the concept that we have already seen, but that will help you to strengthen your concept. And then there are some small concepts that we need to understand further, that I will be teaching you alongside the questions. Okay, along with the questions only, I will teach you what is the relevant concept. Alright. On 1st April of year 20, X Limited issued a loan note with a nominal value of 50,000. Nominal value means face value. The note was issued at a discount of 16%. 50,000 into 16% is how much? 8,000. So face value is 50, we are anyways collecting 8,000 less. And the issue cost is 2,000. Okay, so if I am issuing a loan note, let us say a bond or a debenture of 50,000, I am already giving 8,000 of discount. How much will I get? 50 minus 8, I will get 42. Out of that 42, I am further incurring 2,000 of transaction cost. So net amount, how much did I collect? 50 minus 8 minus 2, net amount collected is only 40,000. This is the net proceeds. The note carries an annual interest rate of 5% of the nominal value. So on 50,000 into 5%, 2,500 is what will be paid. In arrears, bond will be redeemed on 1st of April at a premium of 4611, means they will redeem it at 54611. So basically what has happened, if you see, at year 0 we have net collected 40,000, every year 1, 2, 3, 4, 5 years, no? Yeah, 5 years. You will pay interest of how much will be paid? 2,500, 2,500, 2,500, 2,500 and 2,500, and principal will be repaid at what value? 50,4611, 54,611, because 4611 gets added. So today net amount collected is 40,000, cash flow every year is this much. If you compute the IRR of all of this, they are saying the effective rate is 12%. Effective rate is how much? 12%. I will do a quick cross check for you, again not required for the examination but for you to understand. So 2,500 into present value annuity factor of 12% for 5 years and 54611 into present value factor of 12% for 5 years. Have they given factors? No. So 1 divided by 1.12 is equal to 1, 2, 3, 4, 5. How much did we get? 0.5674. 0.5674. Okay, and grand total 3.6048 into 2500, 9011.9, 9011.9, and 54611 into 0.5674. How much did we get? 30986. 3098.6.2. 3098.6.2 plus 9011.9. If I do, how much do I get? 39998.1. that is nothing but 40,000. So, all the cash flows, when I discount at effective rate of interest 12%, I get the present value. This is IRR. This is the present value or the net transaction price, fair value minus transaction cost. Okay. How should this loan be accounted in the financial statement? Find out the total finance cost and the balance of loan which will appear in the 5 years balance sheet. Pass necessary journal entry in the first year. So, net value is 40,000. So, first year you will pass the entry for bank account to loan account by 40,000. Then with 40,000 every year 12% and 5% payment, closing balance you will calculate like that. At the end you will get nil as the closing balance. Finance cost every year we will pick from this table 4,800 of this 27,111. This no need to calculate again, okay, because you have already shown it here, no need to present that separately. And initial journal entry we have done. Closing balance in the balance sheet again comes from here. So, this table it is just for your summarized presentation. This itself is more than sufficient. Next, financial liability at FVTPL. On 1st April, A Limited issued a financial liability with a nominal value of 1 crore. Liability carries an interest rate of 5% and is due for repayment on 31st March of 24. Business involves in trading financial liabilities in the short term market. Sir, can we trade financial liabilities? Yes, even financial liabilities can be traded in the market. The market is not so mature in India, but it does happen globally. As of 31st March, market interest rate have increased to 8%, discounting factor for 8% is so and so. Explain how the financial liability should be accounted for on 31st March, assuming that there is no active market for this instrument. Now, fair value means we have to determine the fair value. If active market is not there, what is fair value? Fair value is present value of cash flows at whatever is the market rate of interest. Initially, the liability is recorded at 1 crore, interest is 5%. Now, whatever interest you pay, 5% coupon, that will be your expense, okay, that will record it as expense separately. Whereas, the rate of interest has increased to 8%. If interest rate has increased to 8%, then what will be the present value? See, this is a financial liability, it is due for repayment on 31st March of 24. So, 21 to 22, 23, 24, it is a 3-year loan. 1 year has passed by, we are standing on 31st March of 22. Now, 2 years payment are left. Now, when we are standing as on 31st March of 22, what happens here? We need to calculate the fair value. Fair value means present value of remaining cash flows. Remaining cash flows means cash flows for 22-23 and 23-24. 22-23 and 23-24. 1 year after that and 1 more year after that. So, if you look it as a table, 21 we have issued, year end 22, 23, 24. We are standing on this date, 2 years cash flows are pending. So, whatever cash flows we get here and here, if we discount that, we will get the present value. So, discounted at which rate? Originally, the rate is 5%, but for fair value, we take what is the current market rate. Current market rate is 8% and discounting factor is 0.9286 and 0.857. So, in the next year, what is the cash flow? 5% of 1 crore, 0.05 crores. And after that, how much will we pay in the next year? We will pay 0.05 crores of interest and 1 crore of principal, 1.05. So, how much will that be? 0.926 into 0.05, 0.0463. Or what you can do, you can take 1 crore into 5%, you can write 5 lakhs also. We will pay 5 lakhs of interest in the next year and 1 crore 5 lakhs in the year after that. Sir, how 1 crore 5 lakhs? 5 lakhs of interest we have to pay plus 1 lakh of 1 crore of principal. Okay, so this you will multiply by 1.05. So 0.857 into 1.05, it is 0.89985 plus 0.0463, 0.94615. So total is 0.94615. So the value is 1 crore. At the end of year 1, the fair value is 0.94615, 0.94615. So, what is the present value? Present value is 0.94615, that is nothing but 94 lakhs 61,500. Now, my liability was at what value? Liability was initially at value of 1 crore. If the value reduces, is it a gain or a loss? Always remember, if my liability amount reduces, it will be a gain. And if my asset amount reduces, it will be a loss. So, liability amount has reduced, so there is a gain. How much is the gain? 9461500 minus 1, you get 538500. 538500, this is the gain. 5,38,000, around it of that is the gain. Okay. So, gain means you will reduce the liability and credit to the P&L. So, what about interest? Interest that you have paid will be recognized as an expense when you pay it. Then next question, FVTPL liability with own credit risk. Now, this is a very small concept where we need to understand one more thing. Based on the previous question, if you see, if the interest rate became 5% to 8%, what happened to the liability amount? Liability amount reduced. Always remember, if the interest rate increases, the fair value reduces. If the interest rate increases, present value reduces. If the interest rate decreases, present value increases, fair value increases. Now, here interest rate has increased, liability value reduced, and what happened because of this? This became a gain. Now, consider a scenario where the credit rating of the entity has reduced or has gone bad. Okay. So, let us say we talk about, let us say Vijay Mallya. Mr. Vijay Mallya. If you have not heard about him, Google. Okay, settled in London right now, aram se. Now, Kingfisher Airlines was going through a tough time. Now, tell me one thing, if some company's credit position has deteriorated, if the company is not paying loan back on time, if the company is having cash flows problem, will you charge high rate of interest or low rate of interest? See, the moment you see that there is a business which is in trouble, whenever there is a business which is in trouble, the credit risk, what happens? The credit risk increases. Whenever the credit risk increases, the banks will start charging higher rate of interest. Okay. Like if you see the credit rating or CIBIL profile, if it increases, if the company, if the bank feels that the credit risk has increased, interest rate will increase. Now, say for example, we are talking about Kingfisher Airlines, the entity's credit position has deteriorated, the credit profile has gone bad, the credit worthiness has reduced. Now, whenever the credit worthiness reduces, bank will increase the rate, correct? Bank will increase the rate. Now, think of it from the company scenario. Kingfisher Airlines, credit worthiness reduced, rate what happened? Rate increased. Now, the moment rate increases, liability value will come down and there will be a gain. What kind of situation is this? Because the credit worthiness has gone down, I am recording a gain in the P&L. Standard says we cannot allow this. It will not give a true picture. So, whatever are the changes due to own credit risk, that part we cannot recognize in P&L. We will recognize separately in other comprehensive income. We will not show it as a part of P&L. Okay, so let's see. B Limited acquires assets that are measured at fair value through P&L. To finance these purchases, B Limited issues bonds. To avoid an accounting mismatch, the bonds are designated to be measured at fair value through P&L. Okay, you issue liability, you measure it at fair value through P&L. I told you, right, if it is trading category, if it is derivative category, and if it is because of accounting mismatch, you have to take it through P&L. During the reporting period, fair value of bonds decreased by 4 crores, and out of this 1.5 crores of the reduction is attributed to changes in B Limited's credit worthiness. So, how much is the value reduction? 4 crores is the gain, out of which 1.5 is due to change in credit worthiness. So, out of this, what you have to do is, out of this 4 crores, 1.5 you have to take it to OCI and balance 2.5 you have to take it to P&L. Sir, what if there is a loss? Same treatment. Any change in fair value because of changes in credit worthiness of the entity, we will take it to OCI. Please keep this in mind. Let's now move to the next question, and before the next question, we need to understand a small concept. The concept is of impairment. Sir, what is the meaning of impairment? Like we have impairment of non-current assets, right? We have seen impairment of property, plant and equipment. Same way we have impairment of financial asset also. Very simply put, if I look at financial asset, I have cash. Cash unlikely will be impaired. We have debtors or account receivable, we have loans, etc. Okay. Now, impairment means there is some kind of loss on this asset. Ignore cash for a moment, let us say debtors. All of us would have heard of this term, provision for bad and doubtful debts, our favorite topic when we do foundation, when we do 11th and 12th, right? Very complicated topic. Similar concept is applied when we talk about impairment, right? So, whenever we have, let us say, debtors, and we believe that we will not be able to realize full amount from the debtors or the account receivable, we say that it is impaired. Okay. Now there is a lot of guidance given in Ind AS 109, everything is not relevant to us. We need to see how do we calculate impairment on any financial asset. So for that, 2-3 things that you need to keep in mind. When we talk about impairment on financial asset, if the financial asset is measured at amortized cost, we will calculate impairment. If the financial asset is measured at FVTPL, then we will not calculate impairment. Sir, why? Because impairment loss also will be recognized in P&L. So if the fair value anyways is reduced, the impairment will automatically get captured. But if it is fair value through other comprehensive income, then we will calculate impairment. Sir, why will we calculate impairment when we are measuring here at fair value? This fair value changes is recorded in OCI. Impairment losses have to be recognized in P&L. That is why we calculate. Then when it comes to equity, all the fair value changes are recognized in OCI, and because there are no contractual cash flows, we cannot calculate impairment here. Okay, but for debt we can calculate impairment. Sir, what is impairment? Now when we talk about expected credit loss, that is the impairment loss, it is nothing but the present value of difference between the contractual cash flows and expected cash flows. Contractual cash flows means as per our agreement, 6% interest, 7% interest. Expected cash flow, what we are expecting to receive. Maybe our agreement says 10%, but we are expecting to receive only 7%, or we may not receive the full principal. The difference between these two when present value is calculated is called expected credit loss. Now expected credit loss can be done on 12 months ECL basis, on lifetime ECL basis. 12 months means in the next 12 months how much will we lose, and lifetime is over the life of the instrument how much will we lose. Sir, when to calculate 12 months, when to calculate lifetime? Lifetime is calculated when there is a significant deterioration in that asset, and typically if there is a 30-day delay or 30-day past due, once the amount that has to be received has not been received within 30 days of agreed time, then we calculate lifetime ECL, or we calculate the loss expected over the lifetime and accordingly provide for the expected credit loss. In other cases, let's say it has not been 30 days, okay, the credit risk has not deteriorated significantly, in that case we will calculate 12 months. For trade receivables, we can directly calculate the amount multiplied by percentage expected of default. So for trade receivable, like we do provision for bad debt, 2%, 3%, 5%, we can directly do that. No need to calculate present value, because in case of trade receivable, they will make lump sum payments generally. But for other things, let us say like bonds, we can calculate present value of difference between contractual cash flows and expected cash flows. If there is a significant deterioration, the debtor has not paid beyond 30 days, we have to calculate lifetime expected credit loss. Let's look at few questions. X limited trade receivables are short term and do not have significant financing component. When they don't have significant financing component, means there is no interest component. So we don't need to calculate present value of contractual cash flow differences. We can use a simplified approach. Based on historical default rates adjusted for change in forward looking estimates, the following default rates have been estimated. Default rate for not overdue category 0.6, 1 to 30, 1.4, 6.2, 15.8. The gross carrying amount for each category is given below. The loss allowance for trade receivable is 2 lakhs. This is provision for bad debt already existing is 2 lakhs. Calculate the allowance to be recognized in the financial statement. So for 101, what is the expected default rate? 0.6%. This is 1.4%. This is 6.2%. This is 15.8%. So 101 into 0.6%, 0.606. Then 43 into 1.4%, 0.602. Then 16 into 6.2%, 0.992. Then 15.8 into 10%, 1.58. Grand total you can do. So total provision required is 3.78. Already how much do we have? 2 lakhs. So we need to make provision of 1.78 lakhs balance. Okay. Simple question, nothing complicated. Sir, why they have given significant financial component? Again, if it has significant financial component, then we have to calculate present value of difference between expected cash flows and the contractual cash flows. Okay. On 1st April of 21, N Limited acquired a bond for 1 lakh which is classified as financial asset measured at amortized cost. Bond pays an interest of 12% which is settled in arrears at the end of every year. and the repayment of the principal is due on 31st March of 23. 21, 22, 22, 23, 2 years bond. Effective interest rate is 12%. Okay. On 31st March, N Limited received an interest payment of 12,000 of 22. 1 lakh into 12,000. Okay. N Limited estimated that there is a 5.5% probability of default on the bond over the next 12 months. In the event of default within the next 12 months, N Limited expects that no further interest will be received and only 60% of the principal amount will be received back on 31st March of 23. On 31st March of 22, the credit risk associated with the asset is considered low. So here there is no significant deterioration. It is a low credit risk. If it is a low credit risk, we will calculate 12 months expected credit loss. Calculate the following: impairment loss for 21-22, carrying value as on 31st March of 22, interest income to be recognized for the financial year 21-22. Now, in this particular question, they have said that the credit risk is low, so we can calculate 12-month expected credit loss. Now, what is the expected credit loss? Expected credit loss is nothing but present value of your contractual cash flow minus expected cash flow, right? What is the present value of contractual cash flows, which is nothing but the carrying amount of 1 lakh. Now we have to calculate what is the present value of expected cash flow, and on the 12-month basis how much will we lose. Now please remember one thing: present value of expected cash flows over a 12-month period is also 1 lakh, which is the carrying amount, because after the end of 12 months the bond is maturing. Okay, so you don't need to worry about calculating it again. The reason what I am telling you here is, see, what is the contractual cash flow? Contractual cash flow is you will receive interest of 12,000 and you will receive principal of 1 lakh in the next 12 months. Okay, contractual over 12 months. If this bond was due after 2 years or 3 years, then you will only consider interest. Okay, this is one. Then what is the expected cash flow if there is a default? Expected cash flow if there is a default, interest will be 0 and principal you will get only what they said, you will receive 60%. So you will get only 60,000. Okay. Now what is the difference? The difference is here 12,000 loss and here 40,000 loss. Okay. Total loss is how much? Total loss is 52,000. This is the total loss. We need present value. Present value is equal to 52,000 divided by 1.12. 52,000 divided by 1.12. The expected loss, credit loss is 46428. This is the expected credit loss. But what is the probability of loss given default? 5.5%. So impairment or expected credit loss is equal to 46428 into 5.5% is the probability, into 5.5%, which is 2553 or 2554. This is the expected credit loss that we need to provide. Okay. Sir, can we do it in a different way? Calculate present value of expected cash flow and find out the difference as compared to carrying amount of 1 lakh. That also can be done. What I am telling here is, what is the present value of 60,000? Present value of 60,000 is 60,000 divided by 1.12. You get how much? 53571. Okay. Current carrying amount is 1 lakh. Minus 1 lakh if you do, you get 46428, the same number. But this is the case because 1 lakh we are receiving in the next year. But if this 1 lakh was due after 2 years or 3 years, in 12 months ECL calculation that will not come. So what you have to do is, you have to take what is the expected cash flow, what is the contractual cash flow, what is the loss over 12 months, calculate the present value of that and multiply it by probability, you get 2554. Okay. The solution given in the workbook is incorrect because they have confused with the dates, and instead of calculating 12 months they have calculated it for 24 months, that is 2 period, and also the fact that we have received the interest of 12,000 already. 31st March of 22 we have already received the interest. So there will be no loss on this particular interest. Okay, that is one thing you have to keep in mind. Next, on 1st of June of year 19, XYZ provided a loan of 12,000 to ABC, which has a 4-year term. The coupon rate on the loan is 6%, effective is also 6%, so we will issue at 12,000. Interest payments are made annually at the end of each year. On 1st June of 22, 19, 20, 21, 22, after 3 years, 4-year term. The effective interest, ABC informs XYZ that it is facing difficulties. At this point, the current market interest rate has increased to 8%. On 1st of June, the company has estimated the following in respect of this loan. Interest will not be received, principal only 6,000 will be received. XYZ has already an allowance of 15,000 for this loan. How should the loan fee be accounted at this point? Now, here they are saying facing significant financial difficulties. In this case, we will provide for lifetime expected credit loss. Okay. What is the lifetime expected credit loss? Interest will not receive. 12,000 into 6%, 7,000 or 720 interest will not be received. Principal 6,000 will be received, 6,000 will not be received. Now, what is the present value? See, the loan had an effective rate of 6%, so we will consider 6% only. So, 720 plus 6,000, you get total of 6720. This 6720 you divide by 1.06, divide by 1.06, you have 6339. Total loss is 6339. Present value of the credit loss is 6339. Here we don't multiply with the probability, we are calculating lifetime expected credit loss. Okay, we are calculating lifetime expected credit loss. So, the expected loss is 6339. Already 1500 we have provided, balance amount should be provided as impairment loss or expected credit loss. Now, in case of impairment or expected credit loss, right, we have three stages. We have stage 1, stage 2 and stage 3. In stage 1, we calculate income going forward, means future income on gross amount. In stage 2 also we carry on gross amount, in stage 3 we carry on net amount. So, what is the stage 1, stage 2, stage 3? Stage 1 means there is no significant increase in credit risk. Stage 2 means there is an increase in credit risk, significant increase in credit risk, but no impairment, Stage 3 is when it is an impairment. So, whenever we have impairment, then we will calculate on net amount. In the first two stages, we will calculate on gross amount. So, what will we calculate? Future income. So, like in the previous example or the previous question, the gross amount was 1 lakh. On 1 lakh, we will calculate future income. Here, we will calculate on net amount. Net amount means after deducting the impairment loss, what is the net amount? 12,000 minus 1500 minus 4840, we get 5660. On this 5660, we will calculate income in the future period. Okay, so interest income for the next year will be 5660 into 6%. If it was in stage 1 or stage 2, we would have taken on the gross amount, that is 12,000 into 6%. Okay, there is a slight difference and not enough tested, but still we need to know it. Let us now look at the next question. In case of concessional loan, on 1st April, S Limited provided a housing loan of 15 lakhs to an employee at an interest rate of 6%. Loan is repayable in 5 equal annual installment plus interest. Means 15 lakhs divided by 5. Every year you will pay 3 lakhs plus whatever is the interest. Employee is not required to provide any specific performance in exchange for this benefit. Market rate of similar loan by bank is 10%. So, if the employee has to take loan or if the company has to take loan from the bank, it is 10%. Now, in this case, what is the market rate? If loan is given generally in the market, you will get 10%. We have given at 6%. So, there is some form of benefit and it is an off market transaction. Transaction are not at market terms. Now, in such a scenario, how do we calculate? See, we have to see, first we have to calculate what are the cash flows. Whenever you get employee loan, whenever you get parent and subsidiary case, first see what are the cash flow. What are the cash flows? Cash flows are, today we gave 15 lakhs. Every year, how much will the employee pay? So, if you take year 1, 2, 3, 4, 5, employee will pay principal at the end of first year, how much? 3 lakhs. Second year also 3 lakhs. Third year also 3 lakhs. Fourth year also 3 lakhs. Fifth year also 3 lakhs. Okay. Then, what is the interest payable for every year? First year, interest will be paid on opening balance into 6%. See, we are doing cash flow. We are not seeing effective interest rate for now. Cash flow basis 6% will be paid on 15 lakhs. So, 15 lakhs into 6, 90,000. What is the closing balance of principal? Closing balance, see, 15 lakhs was the opening balance, 3 lakhs is paid. Closing balance of principal is 12 lakhs. On this 12 lakhs, next year 6% will be paid, which is 72,000. 12 lakhs minus 3 lakhs principal paid, 9 lakhs is the closing balance. I hope you are able to understand. 9 lakh outstanding, next year you have to pay interest of 6%, 54,000. How much is the closing balance? 6 lakhs. Next year interest will be 36,000. How much is the closing balance? 3 lakhs. Next year interest will be 18,000. How much will be the closing balance? 0. Sir, how did we calculate all of this? Once again, opening interest, first year interest is 15 lakhs into 6%. Clear? Very good. Then out of that 15 lakhs, 3 lakhs will be repaid. How much is left? 12 lakhs. On this 12 lakhs, next year 6% interest will be paid, 72,000. This is for cash flow purposes, for determining the repayment schedule. What is the total cash flow? Total cash flow, if you see, principal of 3 lakhs, interest of 90,000, 3 lakhs 90,000. 3 lakhs 72,000. 3 lakhs 54,000. 3 lakhs 36,000 and 3 lakhs 18,000. This is the cash flow. Employee will repay the amount of loan in this pattern. Now we have to see, if I will get these cash flows, how much loan will I give so that I have to earn 10%? Basically what we need to calculate, what is the present value of loan at 10%. So 1 divided by 1.1, 0.9091 is equal to then 0.8264, 0.7513, 0.6830, 0.6209. What is the present value? 3,90,000, 390, you can just use 390, you can ignore the 3 zeros, into 0.9091 is equal to 354,549. Okay, I hope you can calculate for remaining, right? So when you do the calculation, what is the present value we get? We get a present value of 13,54,602. How do we understand this? If the company wants to earn 10% return and if it is getting cash flows like this, then they will give a loan of only 1354. They will not give a loan of 15 lakhs. But sir, why did the company give a loan of 15 lakhs? There is another benefit provided. The difference between that two is your employment or employee benefit expense. How do we treat this? How many years is the loan? 5 years is the loan. Divide by 5, every year you will book the expense. So what is the first entry? Loan to employee, present value, this is at present value, difference amount will go to here, total amount you will credit to bank. Okay. The table will be based on present value of loan amount given, end balance will be 0. Every year income will be at 10% on opening balance, repayment 390, 372, 354, where does it come from, sir? It comes from this particular table. Okay. And every year you can pass the entry like we do in the case of normal interest income and expense. Provide accounting treatment for loan, interest income and other related expenses in the financial statements of S Limited we have done. Now how do we present that in the balance sheet? In the balance sheet, see, there will be non-current and there will be current portion. Okay. So how do we do it? So we are doing it at the end of 31st March of 21. That is at the end of this period. Okay. How much to show at current and how much to show as non-current? I'll give a very simple trick for you to remember in the examination. So whatever is the closing balance at the end of next year, non-current, difference between these two current. So non-current portion 8,38,000 and current portion the balancing figure. Okay. So if you do 1100,0662 minus 838,068, you get 261,994. 261,994. Another way to calculate this is whatever amount is repaid and minus whatever is the finance cost. The difference between these two is current, balance is non-current. But easier way is closing balance at the end of the next year, non-current, remaining amount current. Okay. Now when it comes to prepaid expense, what is the prepaid expense? 145,398 divided by 5. 145,398 divided by 5. 29079. First year this much will be written off. Next year also 29079 will be written off. So 29079 or 29080 is current and the balance amount is non-current. So 1 year portion is current, 3 year portion is non-current. But sir, there are 5 years, no, 1 year is already completed. So 3 year portion current, 1 year, 3 year portion non-current, 1 year portion current. Let's have a look at the next question. This one is on financial guarantee contract. Again, how do we account for it? I'll give you a very simple example and based on that we'll be able to understand. Let us say we have a parent entity and there is a subsidiary entity. See, I am giving you this explanation from examination point of view. Okay. In actual classes we go in much more depth. Parent and subsidiary is there, and there is a bank. Subsidiary wants to take loan from this bank. Let us say this is Amazon. Amazon is loss making. So the bank says, I will not give you loan. Okay. Or even if I give you loan, I will charge a very high rate of interest. So Amazon goes to its parent company, started saying that this bank is not giving me loan. What do I do? Parent says, okay, I will talk to the bank. Parent is Amazon US. Amazon US has lot of profit, lot of assets. So what Amazon US says is, bank, don't worry, give the loan to Amazon. If Amazon India doesn't pay, this is Amazon India, if they don't pay, we will pay the loan. Alright, we will pay the loan. So what happens here? Parent is giving a guarantee to the bank that if the subsidiary doesn't pay, then the parent will repay the loan. Now tell me one thing, if Amazon India would not have received this guarantee, and say for example bank has given the loan somehow, if the bank charges 12% versus if the parent company gives a guarantee to the bank, how much rate of interest will it charge? Will it still charge 12%? That will not happen, right? Whenever you have more security, interest rate will be lower. So maybe here interest rate may be 10%. So Amazon India is indirectly getting a benefit of what? 2% of the interest saving. Alright. Now why is parent company giving this guarantee to the bank? Because it's a subsidiary, there is some relationship. Generally in real life what happens is, if you want guarantee, if you want even bank guarantee, bank charges something called as commission. Hypothetically assume, parent says, I have given guarantee on your behalf, I am taking so much of risk, and because of which you are saving 2%, you pay me some amount for this. You pay me some amount for this. How much maximum amount will Amazon India pay? Amazon India will say, yeah, I am saving 2% interest for 5 years. Whatever I have saved at present value, that is the maximum amount I will pay. So this amount that will be paid is nothing but the fair value of guarantee. Okay, that is nothing but the fair value of the guarantee. Actually no payment has happened. It is just a service that is, or it is just a benefit that is being provided. So because no payment has happened, but some form of benefit is being given to the subsidiary, the parent treats this as investment in subsidiary, subsidiary treats this as a equity contribution. Alright, now let us look at the question. On 1st April of 21, H Limited provided a financial guarantee for 1 crore granted by bank to its subsidiary. Loan has a term of 3 years with interest payable annually at 7% and the principal at the end of the term. Had H Limited not issued the guarantee, bank would have charged an interest of 10%. H Limited did not charge H Limited any fee for the guarantee. There is nil probability that H Limited will default. Prepare journal, pass the journal entries and working should form a part of your answer, basically accounting. Now, as far as accounting is concerned, parent considers present value of benefit as investment in subsidiary. Okay. So you will have investment in subsidiary account debit. Credit what? Credit what? Credit to financial guarantee liability. Sir, why are we crediting the liability? Array, if at all there is a default in the future, we are carrying this much of liability on our head. That is what we are saying. Then as every year passes by, what will happen is this liability component will start reducing. Okay. Of course, if there is a default, we will have to pay, but the fair value of the liability will start reducing. That amount will be recognized in income. Okay. So what is fair value of liability? Fair value of financial guarantee contract is equal to present value of interest savings. Every year what will happen? So much of benefit has been exhausted. To that extent, the income will be recognized. We will understand in this example. Now, how much is the savings here? Year 1, 2, 3. How much is the savings? Savings is 3%. 3% of 1 crore. 3% of 1 crore is 3 lakhs. Correct? Every year 3 lakhs of savings is happening. Now, what is the present value? Present value of 3 lakhs at, what is the rate? 10%. Sir, why not 7%? Because if subsidiary had to take a loan, they would have paid 10% for 3 years. So that is nothing but 3 lakhs into 1 divided by 1.1 is equal to 1, 2, 3 grand total 2.4868. 2.4868 or 69 into 3 lakhs. If I do, I get 746055. 746055. So that is investment in subsidiary debit 746055 to financial guarantee 746055. Alright. Now this investment is an asset and this liability sits as a liability in the books. Now sir, what will happen subsequently? This liability will be amortized using amortized cost method. Okay. So what will happen? You will have opening balance of 740655. On this you will charge 10% interest, right? And a benefit of 3 lakhs is provided to the subsidiary. Sir, how is this benefit of 3 lakhs provided to subsidiary? This is the interest that the subsidiary has saved. So much of benefit is consumed. See, every year we are giving 3 lakhs of interest savings. 1 year has passed by. If 1 year has passed by, then this 3 lakhs of interest saving is now over, correct? So this much of benefit has been consumed by the subsidiary. So opening balance plus interest minus 3 lakhs if you do, you get closing balance of 520. Now sir, this 520 if you want to check, cross check, 1 divided by 1.1 is equal to 1 year, 2 year, and if you do a grand total you get 1.7355 into, if you do 3 lakhs, you get 520661. If you do 3 lakhs into present value annuity factor of 10% for 2 years, you get 520611. Sir, what is the meaning of this? For the next 2 years, the benefit that is left, the present value of benefit that is left for the next 2 years is 5,20,661. What is my opening balance? 746,055. So 746,055 minus 520,661, 225,394 is the income for the year. Here this is not income, this is expense, and 3 lakhs. Okay, so net amount of income will be recognized. Next year, opening minus closing, income will be recognized. Third year, opening minus closing, income will be recognized. Alright. So with this, we have covered all the concepts of financial instruments relevant for your examination and also covered almost all the questions from the material, from the workbook and the past exam. Now what we will do is we will quickly have a conceptual recap using the MCQs and fill in the blanks, and that will conclude our session. The Indian accounting standards relevant for recognition, measurement and disclosure of financial instruments are recognition, measurement, disclosure 32 yes, 107 yes, 109 yes. So all of the above. Then financial assets are cash, yes. Equity instrument, yes. Contractual right to receive cash, yes. All of the above. Financial instrument classifies financial asset and liabilities into the following categories: measured at fair value through OCI, measured at amortized cost, measured at fair value through P&L, all of the, yes, all of the above. Ind AS 109 deals with recognition and measurement, presentation, disclosure of financial instruments, none of the above. Disclosure 107. Okay. And here you can see presentation Ind AS 32. So presentation is 32, this by Ind AS 109. A dash is any contract that evidences a residual interest, equity. This fill in the blanks you can run through on your own. If you want these documents, link is there in the comment section. You can download it from the free resources section of our app. I hope if you have watched till here, you have actually enjoyed the revision session, and do let me know what is the next topic you want me to take in terms of your revision. Thank you.